Meeting. Fed Chair Jay Powell are likely to make a hawkish pivot in his news conference following a series of hotter than expected inflation prints. A conversation we'll have with David Rosenberg a little bit later this morning. Hawkish relative to what? That's the most important market question I think we have going into this news conference. Is it relative to the last meeting or relative to what is already priced in the market? Because as we said at the start of the program, Bremo, one is a much higher bar than the other.
And it really goes down to, does he want to engineer a sell-off? Right, this hasn't been a Fed chair that has shown any particular proclivity toward hawkishness in any of the recent meetings. You showed the Alan Ruskin stat. Here's really the issue for me. Does he view the pivot back late last year as a policy error? And that's what a lot of people have been saying. And if he does he want to reverse it by saying, yes, hikes are on the table, engineer a sell-off that could potentially move them closer to their goal?
Well, Earl Davis will be joining us later, and he talks about a partial Fed pivot that Jay Powell is going to try to conduct today. And basically that means leaving some optionality open for July and September easing, but acknowledging that that window is starting to get very narrow.
Decision at 2 p.m., news conference 30 minutes after that. Look out for that this afternoon. Elsewhere, Tesla announcing more job cuts. The company eliminating almost its entire supercharger organization, which has built a vast network of public charging stations that virtually every major automaker in the US is tapping into. In a post on X, Elon Musk said this: Tesla still plans to grow the supercharger network, just at a slower pace for new locations and more focus on 100% uptime and expansion of existing locations. If you are a major manufacturer that's started to make the shift to be able to use this network, Lisa, what are you thinking this morning?
Well, we know Rivian, Ford, GM, they're angry. I could use some other words. They are not very pleased because they're actually adapting their technology to cohere with some of these chargers. So here's a question. How much does Elon Musk hold the keys to the entire electric vehicle adoption in the United States? And if he does, is he basically just sort of flipping off the entire industry right now?
Reading some of the reporting and some of the statements made by some of these companies, they are blindsided. This was a huge win for Tesla. They were coming onto their charging networks, but you have to think of what Musk said in this report from the information, quote, we need to be absolutely hardcore about headcount and cost reduction. Well, this is hardcore.
So it's not just the US manufacturers, it's the Europeans as well. So Volvo, Kia, Honda, Mercedes, BMW, Europe, Asia, take your pick. I wonder if, reading between the lines, there's a little dear White House, dear Brussels, come on board. If you want us to do a little bit more, hire more people to roll this out, we can help, but we're going to need a little bit more.
Especially with the juxtaposition of his visit to China, especially given the fact that they're over there trying to get the nod from Xi Jinping. They're basically saying we're not going to provide the infrastructure unless we get some sort of nod. You're correct. I do think it's not a coincidence that both of these things happened.
Yeah, I did wonder when I saw the story in the last 24 hours. Let's turn to this. US Secretary of State Antony Blinken renewing calls for Hamas to accept a ceasefire deal. In a meeting with Israeli President Isaac Herzog, Blinken saying this: even in these very difficult times, we're determined to get a ceasefire that brings the hostages home, and to get it now. And the only reason that wouldn't be achieved is because of Hamas. Joining us now for more, Stephen Cook, Senior Fellow for Middle East and Africa Studies at CFR and author of the upcoming book, The End of Ambition. Stephen Cook is with us now. Stephen, let's go to the first question, sir. A question we've been leaning on over the last 24 hours or so. Are we actually close to a deal between Israel and Hamas or not?
It doesn't seem like we are very close, although the reporting would suggest otherwise. The problem is that Hamas would have to give up the one piece of leverage it has in this conflict, and that is the remaining Israeli hostages, especially since the Israelis have not been willing to commit to an actual end of the conflict. There has been some talk of a sustainable calm over perhaps 3 months, but the Israelis are determined to finish this conflict the way they started it, which is destroying Hamas's ability to threaten Israeli security. There's really no indication that the Israelis have given that up. As a result, the Hamas leadership, particularly the Hamas leadership within the Gaza Strip, doesn't see any reason to really move forward in this ceasefire for a hostage deal.
When do you then see Netanyahu directing the IDF to go into Rafah?
Well, that is a more difficult question, although the IDF has recently indicated that they're fully ready to go into Rafah. It's important to note that the Prime Minister has said whether there is a hostage deal or not, Rafah is going to happen, which puts him in direct conflict with the President of the United States, who has continued to say that he does not support a Rafah operation. The real issue in Israel is that there is significant political support for going into Rafah, and to not go into Rafah potentially breaks Netanyahu's coalition. So I think it's quite likely that there will be some type of operation in Rafah. The Israelis are saying they're ready. That may just be a negotiating tactic here, but nevertheless, I would expect it at some point.
So even if we do get a deal, you do expect Netanyahu to go into Rafah, but how much time could a deal potentially prolong that decision from Netanyahu?
It certainly can prolong it well into the summer months or even into the fall. The leaked documents about this potential deal talks about 100 days of a ceasefire. An initial 16-day ceasefire in which a larger number of Israeli hostages would be released in exchange for Palestinian hostages, and then two 42-day periods of calm. So if it happens, it could delay the Rafah operation a number of months. But the Israelis seem determined to not go back to the status quo ante.
How much do the protests that we see across universities in the U.S. and frankly also in the Middle East and Europe really prolong the conflict in the sense that it makes certain members of Hamas less likely to really accept a ceasefire?
I think it has a dynamic effect on both sides. These protests are being covered wall to wall by the Israeli press. We have seen Hamas figures and Hezbollah figures praising university students. So the Hamas and its allies believe that they have the momentum of global public opinion behind them. The Israelis feel more and more isolated and feel like they have less and less to lose by going into Rafah. They'd be damned if they do and damned if they don't. So I do think that it has a dynamic effect on the ground in terms of prolonging the conflict.
What do some of the Arab allies of the United States, and probably secretly of Israel, think about some of the protests that are going on in the United States? And I'm thinking, for example, of Saudi Arabia, as well as Jordan, as well as Egypt.
Well, it's undoubtedly the case that they understand that the politics of Israel and the United States may very well be changing as new generations come into the positions of authority in the United States. But they are really focused on bringing a ceasefire and an end to this conflict. So the protests on college campuses is an interesting sideshow. I will note that in addition to the Israeli press, Al Jazeera is also covering this wall to wall. But Arab officials are more concerned actually with the state of affairs in the Gaza Strip and what will come next, and whether there will be, in the words of American officials, a concrete, time-limited, credible path towards a Palestinian state. The protests, from their perspective, are neither helpful nor hurtful, just an interesting side story to the overall conflict in the region.
Stephen, do you believe the end game is still the same, that Israel will probably end up reoccupying Gaza?
It's hard to see how they are not going to. The plans for the day after remain essentially what we've been talking about since October, November, which is a revitalized Palestinian Authority, and with the help from major Arab partners of the United States. The problem is that none of those parties actually have the capacity to maintain calm in the Gaza Strip at the same time rebuilding it, while they have also requirements that there be a credible process towards a Palestinian state. That leaves the IDF there to provide, quote unquote, overall security, in the words of Israeli officials. And then let's add into this mix the radical right in Israel, which is has a potent political argument about settling the Gaza Strip. In 2005, they said if Israel withdrew from the Strip, there would be all kinds of security problems. After October 7th, that argument makes more and more sense to people. And there's a fairly significant number of Israelis, according to polls, who would support resettlement of the Gaza Strip. So this is by no means something that is going to end with a ceasefire and hostage agreement, or even if the Israelis call off a Rafah operation.
I wonder where this would leave President Biden's position, Steve, and if we could focus and end on that. As we talked about, as we discussed, college campuses are a mess. Biden is losing the youth vote. We can see that in poll after poll. Then we're trying to work out whether the president's domestic political struggles will reshape his view of America's role in the Middle East. You've written about it, America's future role in the Middle East. Stephen, how will it shape that? Not just for this presidency, but maybe for future Democratic presidencies as well.
I think the president, you can trace back everything to his bear hug of the Israeli government, which the Israelis interpreted as giving them license to prosecute the war however they pleased. I think President Biden and his advisors believed it bought him the ability to influence those military operations. Now the United States seems to be going down the road of a big, ambitious project to build a Palestinian state. And we know how that has worked out over the previous 3 decades. It's likely to end in failure, and it's likely to be blamed on the United States. I think the United States needs to lower its ambitions for what can possibly be done in the Gaza Strip. And the first priority is to make sure the Israelis don't reoccupy it and don't resettle the Gaza Strip.
Stephen, appreciate your perspective, sir. Thank you. Stephen Cook there of CFR and author of The End of Ambition, America's Past, Present and Future in the Middle East. Let's give you an update on stories elsewhere. Let's get your Bloomberg brief. We can do that with Danny Berger. Hey, Danny.
Hey, John. Johnson & Johnson is hoping a bigger payout will resolve ongoing litigation over its allegedly tainted baby powder. The company is set to ask thousands of people suing it to agree to resolve the claim for $11 billion. That's $2.1 billion increase to offer it made last year. In a release this morning, J&J urges those who blame the talc-based powders for ovarian cancer to support a third bankruptcy filing aimed at settling all current and future claims. A luxury cruise IPO is likely to begin trading this morning as Viking Holdings. They raised over $1.5 billion, pricing near the top end of its range. The company and its investors are offering shares for $24 a piece. The IPO, it will create a neat little $5 billion fortune for Viking's founder, who's focused the business on wealthy customers and no kids. GM CEO Mary Barra told Bloomberg's Emily Chang why she's betting big on electric vehicles and autonomous driving, technology that she says will be crucial to the next era of cars.
I think it was overhyped, and now it's probably underhyped. And the truth is somewhere in the middle. But, you know, again, yes, growth has slowed, but it's still growing.
The Circuit with Emily Chang airs tonight at 6 p.m. Eastern in New York. That's your Bloomberg Brief. John.
Danny, thank you. The Circuit's had a brilliant start. Looking forward to more of that a little bit later. Viking cruise. Okay?
Yeah.
The one cruise I might consider going on.
River
Just
cruise.
the one.
Where
Just
would you
a
go?
river cruise.
Where would you go?
With my
Don't
parents.
know. Don't know. Somewhere in Europe, okay?
Go down to Croatia.
Is that something you'd like to do?
It's
Team trip?
Team trip to Croatia.
TK's been trying to make this
I
team
know,
trip
I'm
happen
telling
for a
you,
while.
A small river cruise down the Croatian coast could be really beautiful.
I wouldn't go on Icon of the Seas. You couldn't pay me enough money. But if
the sweet
TK
guy.
is willing to pay for a Viking river cruise, I might get on board.
We can discuss that
I can
later.
handle that. Up next on the program, when bumps become a trend.
It would take something like an acceleration in inflation from where we are and a continued acceleration through the year to really get that conversation on the table of raising rates.
The brilliant David Rosenberg just around the corner from New York. This is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
Kicking off May with equities lower by 0.4% on the S&P 500. Just a bit of a pullback building on last month's losses. In the bond market, yields just about unchanged, almost up a single basis point on a 10-year 468.83. Under surveillance this morning when bumps become a trend.
For the Fed, if they do feel they're restrictive, they would rather just hang out at these levels for longer than have to raise rates again. I think it would take something like an acceleration in inflation from where we are and a continued acceleration through the year to really get that conversation on the table of raising rates. I think he'll still say that they feel they're restrictive.
Here's the latest. Fed officials expected to hold rates steady for a sixth straight meeting today, with traders preparing for a possible hawkish pivot from Fed Chair Jay Powell at his news conference. David Rosenberg of Rosenberg Research writing that what hawkish now means relative to market pricing isn't what it once was. Powell seems to be moving away from his earlier view that the inflation pickup in the first 3 months of the year was due to mostly some statistical aberrations. That said, I still believe that this inflation deviation from the second half of last year is going to be corrected. David is with us right now. So David, two-part story. I'll get to that aberration in just a moment on inflation. I want to start with this hawkish shift. So many notes we've all read have said the same thing. A hawkish Chair Powell in the news conference. I think you've absolutely nailed it. Hawkish relative to what? Because hawkish relative to the last meeting is a pretty low bar. Relative to what's priced is a different story. How hawkish, David, is this going to be?
Well, I think at this stage, for Powell to sound hawkish enough, I think, to move Treasury yields higher, he'd either have to strongly suggest that all the rate cuts, and there's really only one and a bit left for the year, they're just off the table. Or for sure, he's going to be asked at the press scrum as to what his view would be on the possibility of the Fed actually moving towards raising rates again. And if he doesn't push back on that, that could be a very important market mover. But that's where we are right now. We're no longer with the bar set at 6 or even 3 rate cuts, which were in the last set of dot plots. So I would say that he's going to have to sound hawkish enough that either there's no rate cuts coming whatsoever, or the prospect that maybe the Fed's next move is going to be to hike. And there's some market chatter to that regard over the course of the past several weeks.
David, I want to go to the second point that John was talking about. The first being, hawkish relative to what? The second being, you still believe that disinflation is coming down the pike and that the recent data that we've seen that's been harder than expected has been an aberration. What gives you such confidence?
Well, I don't know if I really have a crystal ball as to, how long we're going to be seeing, auto insurance going up at a 20% annual rate. If we go back to 2021 into 2022, the poster child back then were used cars and car rentals, and they were just soaring to the moon. That didn't last forever, right? So we have auto insurance, we have tenant, homeowner insurance, financial services, and of course, what's been frustratingly slow is the descent in the dominant rental measures. But the reality is that when you're looking outside of these factors to show how bifurcated the story is, and people will say, well, this is data mining, but it's really just to identify that there's a real split in the data. Because when you actually move away from insurance premiums, which is not really about the economic cycle and the arcane way that the rents are treated, financial services, well, broker commissions and the like, well, that's related to what the stock market's been doing up until recently. But everything else collectively is running around 1.5% on a year-over-year rate. So if you can build a straw man that these factors that precipitated, the bump up in inflation January, February, and March were due to these, what are still idiosyncratic and isolated components of the CPI and PC deflator, and then we can possibly revert to the pattern of the inflation data and the core inflation data in the second half of last year, I think the Fed's going to be quite a bit more comfortable as we move to, I would say into the July meeting. The numbers are going to look quite a bit differently.
David, yesterday we had a surge of employment cost index. We also had a reacceleration or acceleration of housing prices. And then the conference board, when you look at consumer confidence, is the lowest since July of 2022. How does Powell deal with this barrage of pretty bad data just within the last 24 hours?
Yeah, again, some huge divergences. What was interesting in the employment cost index was when you're taking a look, for example, at areas like financial services, they weakened off quite a bit. Retail was actually down, which is a big surprise considering the minimum wage increases in California. And leisure hospitality, of course, which is what Powell was focused on just a year and 2 years ago as signs of mismatch in consumer cyclical services, that also slowed down dramatically. A lot of that ECI, again, was highly concentrated in state and local government. And manufacturing, we saw a bulge, even though it's interesting, manufacturing, we know, look at the Chicago PMI yesterday, or look at all the aggregate data in manufacturing, the industrial sector is indeed in a recession of its own, and yet manufacturing was a leader in the ECI. Why? Well, because we started to see the initial impact of those UAW settlements kick into the data. Again, that was not a broadly based report. That is not something I'm going to point to and say, well, we have some massive wage inflation going on in the U.S. economy. It was really, once again, a big divide between, some of the more private cyclical services areas, which actually 2 years ago were a big source of a problem. They're starting to slow down. And you mentioned about the conference board survey, the consumer confidence survey. It was very interesting because the first thing you think about with such a big decline in consumer confidence in April was that, well, that must be because of inflation. But actually, the 1 year inflation metric stayed the same at 5.3%. It wasn't inflation. You know what the weakest component of that report was the assessment of households on the labor market, both currently and the assessment over the next 6 months. And I'd have to say that if that assessment on the jobs market is accurate, it's going to be tough for people to go to their boss and negotiate for higher pay packets. So again, I'm looking at what happened with the ECI in the first quarter, again, as something that's not going to be sustainable.
So, David, just quickly, what would you say to people throwing around the stagflation word in the last week or so? What would you say back to them?
It's ridiculous, okay? Stagflation, what I mean, we have a 3 handle on inflation. Do you know that, when they talked about stagflation in the 1970s, if you describe today's situation back in the 1970s, anybody who was around back then, you'd be a laughingstock. But people just throw around these words without even understanding what they are. I do think that we have a stagnant economy, and it's not evident really in the government data, but there's not a snowball's chance in hell that you can read the last Fed's beige book. The beige book's been around for over 50 years.
Yeah.
And it was replete with signs not of a recession, but of an economy that's pretty well flat on its back. It is not comporting a lot of the other data that you've been seeing on the real side of the economy. But what's most important was what we're already seeing out of places like, Walmart and Starbucks, is that across a broad array of the retail sector, companies are losing pricing power. So where's the inflation in that? Yeah, there's inflation in that. It's called disinflation. And that's what we'll be talking about 6 and 12 months from now.
David, you're one of the best. It's fantastic to catch up with you, sir. David Rosenberg there of Rosenberg Research. We heard that from Walmart executives almost on repeat over the last few months. Speaking of Walmart, just some difficulties around the healthcare story and retail.
Yesterday we heard, or a couple days ago, we heard about Walmart closing health centers and telehealth units due to rising costs. This morning we're seeing CVS tumbling. They cut their full year forecast because of, guess what, rising costs associated with some of their foray into healthcare. So it seems like there's some trouble there.
Stock is down by 12% in early trading. Coming up next in the second hour of Bloomberg Surveillance, Tony DeSpirito of BlackRock, Bloomberg's Mario Parker, Vasilios Giannakis of Aviva, and Earl Davis of BMO on why this 10-year he thinks could test 5%. That's coming up shortly. This is Bloomberg.
linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Earnings season has been going well enough, not awesome, but pretty good. And so obviously right now that's the focus.
Earnings by and large are not great, but okay enough.
We are starting to see in some areas a few cracks.
Not all of these companies can navigate high for longer the same way.
All of the earnings growth is 5 stocks again, but I think that's going to change as we move through the year.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Stocks down, bonds down, yields a whole lot higher. Good riddance, April. Hello, May. And standing in the way of gains on the first day of May, a Federal Reserve meeting just around the corner. Equity futures negative by 0.4% on the S&P 500. On repeat, we have heard a hawkish Chairman Powell is coming to you in the news conference. Bramo, how hawkish?
And hawkish compared to what, as we were just talking about with David Rosenberg. Is he going to come out with any conviction saying that there has been a material shift in the trajectory of inflation? Or is he just going to say that there isn't the same degree of confidence that he was hoping for to essentially connect the dots, cut rates in June?
Would he gain confidence or lose confidence was the question we asked after the last news conference. Arguably, he's lost some. This is what I want to understand. Do they acknowledge that the disinflationary process has stalled? Do they acknowledge that in the statement? Do they acknowledge that in the news conference? Or are they still referring to this as bumps in the road?
It's a great question. And basically, really it comes down to what do they want the response in markets to be? Because you have to imagine that Jay Powell is savvy enough to know if he says that this has been a stalling out of disinflation, that will be read by a materially more hawkish Jay Powell in the market, and it will incur some sort of sell-off. So does he want that or not, I think, is one of the key questions.
Claudia Sam put it well. When he opens his mouth, there's going to be downside risk. If they admit that this isn't just bumps, then what was the point of the pivot they made in December? December. And I think that's why he has to come out and say, we are still monitoring this data, and at the moment, we do see disinflationary trends.
At 2 p.m., the decision just around the corner. 2:30, the news conference. 30 minutes later, the price action going into it looks like this. Equities are lower by 0.4% in the bond market on a 10-year, approaching 470, 468. The move we've seen in the last month, unreal, both at the front and the long end. At the front end, we've had a move of about 40 basis points. At the longer end, something around at least 50 basis points higher on a 10-year. And against that, equities lower and down about 4%.
So I'm going to say something that I don't normally do, which is at this point, I'm not as interested even in bonds as I am in what's going on in specific stocks and what that says about where the economy is, because I'm not getting a clear read on things. Basically, yeah, there's this question of, oh, can companies sustain themselves on these yields where they are? But then you start looking into which companies are doing what. And we talked about Starbucks, we talked about McDonald's, we talked about Amazon away from AWS. There's clearly pressure. You know, there is clearly a sense that they can't pass on the same kind of price increases to consumers. So how do we pair this with this idea that other places are seeing real growth and we're seeing a sort of rebound in inflation? This is what I'm struggling with.
Well, let's go to Starbucks and let's put the name up on the screen. In the pre-market, down something like 12% through most of this morning. We touched on some of the Southside research earlier on. Southside research on Starbucks today is pretty brutal. The takeaway, stunning across-the-board miss. A stunning across-the-board miss. The name is down about 13%. I referenced some of the work from William Blair. The tide has turned quickly. From Jefferies, a notable miss. The likes of Citi. This quote from Citi I've read already. It's worth repeating, Lisa. Starbucks is putting a lot of oars in the water to try and paddle, struggling to move.
And part of this is just a reset that isn't working, right? Part of this is just a lot of competition with respect to how much you can possibly pay for a cup of coffee that has some milk in it. And then there's a question of, you know, protests of American brands, particularly Starbucks and McDonald's, due to the U.S.'s backing of Israel with respect to what's going on in Gaza. My bigger question is, it's not just these. We also heard that from Amazon in their retail unit. So clearly there's something bigger going on. And you put that with the beige book, and it's just a really unclear picture.
When I look at Starbucks, the one line that stood out to me yesterday, because since January I've been talking about their pricing power or the lack of in China. China comparable sales down 11%. Estimate was for 1.6%. The same kind of issue with EVs. The price cuts you're seeing in coffee in China. Starbucks, even though with this brand that they have in China, it's not working.
Is it a problem with US brands, which is kind of what you were alluding to just moments ago?
And this is kind of what you're seeing in certain places, that multinationals, and you've been asking this for a long time, are multinationals benefiting from the diversification overseas, or are they suffering from not being highly leveraged to the American exceptionalism and being vulnerable to some of these international pressures?
It's not as easy as it once was. Choppy waters internationally, stronger dollar in the mix as well. The stock is down by something like 13% in the pre-market. Coming up this hour, Tony DeSpirito of BlackRock, with stocks snapping 5 months of gains. Vasilios Giannakis of Aviva on the dollar strengthening ahead of the Fed decision, and BMO's Earl Davis looking for the 10-year yield to test 5%, which, let's be fair, is only 30 basis points away. We begin with our top story. Markets on edge ahead of the Fed decision. U.S. equities closing out a difficult April with the worst day since January. To discuss, Tony DeSpirito of BlackRock joins us now for more. Tony, you describe yourself as actively bullish. Could you help us understand what that means in practice?
Sure. So, John, what I mean by that is, in terms of the market, I'm pretty positive, right? I think we're in a decent setup. We've got earnings that are growing quite nicely for the first time in a while, right? So, you know, right now estimates are running a little above 3%. By the end of the quarter, by the end of the reporting season, we should be close to high single digits, close to double digits. So I think the economy, I actually think, is doing well. Yes, there's some bumps along the road, but generally the trajectory is quite positive, earnings growth quite positive. So that's good for the market. But where I get really excited is the opportunity for active management. And I think about that as it's skill times the opportunity set, and the opportunity set is dispersion. And right now, I see a lot of dispersion. I mean, I've heard you talk about that this morning. Some companies doing really well, some companies doing really poorly, very big differences in valuations amongst companies. To me, that's a stock picker's paradise. And so that's why I use the word actively bullish, bullish about the markets, but particularly bullish about the opportunity set for skilled active managers in this market.
Tony, what do you make of these big moves that we're seeing? Peter Chia of Academy started the week by asking whether 10% was the new 1%, just in terms of intraday moves post-earnings for mega cap names. What do you make of some of these moves? Just double-digit moves here, there, and everywhere.
Yeah, so you're right. The moves have been quite large. I mean, part of that's like, look, the market has changed a lot. Even though we had a tough April, the market's still up 20% since the October lows. It's still up 6% year to date. And so I think, yes, there's some volatility under the scene. Again, volatility is good for a skilled stock picker, but generally the trajectory of the market is still quite nicely up.
Some people were talking about a rolling recession that's basically cleaned out certain sectors. And then we heard from Max Kettner, essentially, that it's been a rolling Goldilocks, and that basically you just have to lean into this Goldilocks narrative. Is that what you see, a rolling Goldilocks that's sort of going through different sectors that right now is highlighting and putting a halo around AI and energy, and we'll roll somewhere else pretty soon?
Yeah, so I wouldn't use the Goldilocks word, but I do see this rolling, recession recovery, so to speak. And I think that's a lot to do with the dance of COVID, the push and pull, where we've seen, chip shortages, then chip surpluses, for example. We've seen, step changes in inflation, auto costs, insurance, et cetera. And so all that's created this, as you put it, this kind of rolling recession. So 2022, really tough year for technology companies. They responded by cutting costs. And then, 2023, you have a better cost base and improving revenues, and you have an earnings, explosion, a positive earnings explosion. When I look at the market right now, the market's very concentrated in this Magnificent Seven, so to speak. And if you look at the earnings estimates, the Magnificent Seven earnings growth has been quite high, a lot higher than the rest of the market. And the valuations reflect that. What's interesting is if you look out at quarterly earnings estimates, by the end of this year, the estimates for the Mag 7 versus the rest of the market basically normalize, they equalize. And yet you're paying a lot more for the Mag 7. Now, I think the Mag 7, the earnings will probably come out a little better than what the estimates are, but still, it'll be pretty close to equal. And I think that goes, again, to this idea of the market broadening out and that being an opportunity for stock pickers. And I think we will see that over the next, several quarters.
How challenged is this broadening out thesis, not just from the Fed holding rates where they are, but this idea that we're seeing a consumer that does seem to be pinched? I mean, we're talking about Starbucks, we're talking about McDonald's, we're also talking about Amazon, apart from AWS, highlighting a real slowdown in terms of online purchases. How much do you see that as really hampering an ability to broaden out at a time where there really is a two-speed economy, where there is a growing number of people really struggling?
So I actually think that's a healthy part of the process. What we're hearing, when I speak to individual company CEOs, et cetera, what I hear is a consumer being more selective. And I think that's a function of this step change, so to speak, in prices that we've seen. And I see that as a good thing, because when I look at consumer spending and consumer savings, I see a consumer that's been spending at an above trend rate, meaning the consumer savings rate is too low. It's hovering just over 3%. Normal is much more like 6%, right? And so I like the fact that the consumer is getting a little bit more selective, a little bit more conservative. I think that's good for the long run. The other positive I see that we haven't talked about is just productivity growth and population growth. Both of those have surprised positively, and that's also helping to sustain the economy, even though the consumer is being more conservative.
Tony, you spent a lot of time on your note talking about the election and the fact that actually companies aren't talking about it, even though many are saying that this is the most consequential election in our lifetime. Is that just because these two individuals are known knowns?
Yeah, it's pretty interesting, right? Because we've gone back since the elections going back to 2012, and using our AI techniques have gone back and read through effectively called transcripts. And companies are talking less at this stage. Now, we would expect it to increase as we get closer to the election, but fewer companies are talking about the election. I agree with you. I think it's largely because we have two known candidates. And I don't think we also are going to have, I think no matter how it comes out, we're going to have a lot of close calls, whether that's at the presidency, whether that's at the House or the Senate. Yeah. And so I think that means not big policy changes from here.
I think they all understand the pitfalls of talking about politics now as well, Tony. Tony, it's good to hear from you, as always. Tony DeSpirito of BlackRock there, actively bullish. Talked about this in the last hour. Just getting confirmation of it now from the Treasury. The Secretary of the Treasury, Janet Yellen, will travel to Arizona on Friday to deliver a major address on the economic case for democracy. This is going to be an interesting one, Anne-Marie. So basically, this is going to be a speech, it's my framing, not theirs, which essentially takes on some of the ideas of the former president running to be president for a second round without actually naming him.
Nope, and she's going to basically tell what the Biden administration, the Biden campaign is trying to talk about, that this election is about democracy versus autocracy. Also, it's interesting, this comes on the heels of the former President Donald Trump sitting down with Time magazine, a very long and extensive conversation. And he was asked yet again, as he's been a number of times, about that quip he made about being a dictator on day one. And he said, look, I was just joking. But he did get into a number of economic policies that are very different than what this administration is trying to put forward.
I mean, honestly, the idea of Fed independence, he kind of put front and forward, right? And there's been a lot of discussion around that whole idea, possibly, of him being able to have veto power, the feasibility of it. But even sort of middle-of-the-road types of columnists, Tyler Cowen, for example, of Bloomberg Opinion, coming out and saying Trump's Fed plans make no sense even for him. Other people questioning how realistic this is or whether this is some of his advisors kind of pushing him in one direction or another. How much is this Yellen acting as a proxy to President Biden to try to make a cohesive argument against this in a way that can appeal to possibly the business community that hasn't necessarily picked a side yet?
Short answer is a lot. I'll say that, a lot. I'll go on to say this because it's TV and we should speak for longer because we've got to get to a certain time. So a lot.
You're crushing it.
Thank you.
Yeah.
Does this poll well? This is what I'm thinking about. You know, the president did an address at the White House Correspondents' Dinner on Saturday and talked about some of these themes, and then the comedian afterwards, some of you might say so-called comedian afterwards, basically finished with an endorsement of the president, also on a similar theme. Does this poll well? Because so much of this stuff, to me at least, sitting here, is very well known, well understood. I get that one person stands for this, so I understand that one person stands for that, and then I look at the polls and I'm like, okay, well, still behind in swing states. Does this poll well?
Well, it hasn't really been done before. You never had a president come out and say, this is what my agenda is going to be about. What has polled badly for the president is the fact that people are still feeling inflation. And we continuously see that. We saw that in our most recent poll of swing states, and we saw it most recently in the CBS poll, looking at all the blue walls, that people are still feeling the economic pinch of higher prices and inflation, and that is what is hurting Biden's poll numbers right now.
But wasn't Biden just running as the anti-Trump? And they sort of, political careers of both of them kind of are tied to one another?
Sure.
And that's essentially,
they're married
politically.
What I'm asking is, he's trying to make this election about the future of democracy. We all understand that. Haven't we all got the message? That's what he's trying to make it about. I'm trying to understand whether that's actually polling well, because based on the polls I've seen, not so much.
Get the sense a lot of people are tuning it out, and I get the sense that a lot of people are tuning out highfalutin rhetoric on both sides because there have been a lot of accusations thrown back and forth. It's a good question. Right now, it seems like everyone's just going la, 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 hope it's going to end.
I'm with you. Great TV. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Quick check on Amazon, up 2.2%. As you were discussing, its cloud unit did post stronger sales in the year, but its push into AI for AWS has come at a cost. The CFO saying that CapEx will meaningfully increase this year. Now, as for the e-commerce side of the business, Amazon's forecast fell short of estimates, but eMarketer's Blake Drosh told me earlier this morning that Amazon can capitalize off of price-sensitive buyers.
Consumers don't necessarily stop purchasing these products. They trade down. And Amazon is another thing that they've done last year is they've expanded their consideration set. So consumers who are looking to trade down can find cheaper options and still access that fast and free shipping.
Now, some new details for you on Microsoft's big spending into AI. The company's decision to invest heavily in OpenAI stemmed from concerns about falling behind Google. Those details came from an email. It was released yesterday as part of the DOJ's antitrust case against Google. The DOJ is currently arguing that OpenAI's ChatGPT and other advanced tech could have been released years ago if Google hadn't monopolized the search market. Harvard economics professor Ken Rogoff says financial markets will thwart any political pressure on the Fed. Earlier this week, as you were just discussing, reports suggested that Donald Trump's advisors are drafting plans to give Trump more control over the Fed. Rogoff spoke with Bloomberg yesterday.
If you take away Fed independence, investors are going to get jittery, inflation expectations are going to go up, the dollar's going to tank. So happily, for better or for worse maybe, I think markets will throw a pretty cold bucket of water on the president if he tries to do that.
That's your Bloomberg Brief, John.
Thank you, Danny. Thank you very much. What did you say, Liz Truss moment?
That's essentially what he's describing. Yeah. Dollar tanks, yields go up, Market says, nope, not gonna have this.
In the first term, the markets were sort of like a limit on the president's ambitions, and then he'd back away. Do you think that's going to be the same this time around?
I have no idea. Do you think that I'm a Trump whisperer? I have no idea, but the real issue is that nobody has any idea, which is a reason why people are tuning out.
Thank you, Lisa. Up next on the programme, pushing for a ceasefire.
There is a very strong proposal on the table right now. Hamas needs to say yes and needs to get this done.
A conversation up next, live from New York City this morning. Good morning.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Will invade Rafah regardless of any agreement. Bloomberg's Mario Parker joins us now from Washington. Mario, the Secretary of State describing the proposal as a very strong one. He's also described it as extraordinarily generous from Israel. Mario, could you describe the offer that's currently on the table?
Sure. What you're saying is Secretary Blinken essentially trying to apply some public pressure on Hamas to accept this deal, which would include essentially 33 hostages returned in exchange for hundreds of prisoners who are in Israeli hands right now at this point. A ceasefire for about 6 weeks or so. It's a little bit unclear on the exact timeline in that regard, but the consensus seems to be about 6 weeks or so, and then discussions to move toward some type of longer-term peace deal or ceasefire between the two sides.
How big of the gap right now is it between the Biden administration and Netanyahu, who came out yesterday and said they will go into Rafah, but I'm just reading over Admiral Kirby yesterday who said we can get 6 weeks of a ceasefire, and then we believe his words, there's a decent chance that we can get something even more enduring.
Yeah, well, what you're saying right now is just politics at play, right? Not only the geopolitics, there's the politics that the administration is feeling on this side. There's the politics that Netanyahu is feeling on his side as well, right? So you alluded to the strong comments that he made yesterday where he said that they would be going into Rafah, deal or no deal. You're seeing some pressure to his right. And keep in mind that Netanyahu is on the right side, but he has some attacks some pressure from the right flank of his own party, essentially saying that if he doesn't invade Rafah, there'll be walkouts, essentially maybe putting his hold on power in jeopardy. So he's trying to thread the needle on both sides there as well.
Steve Cook earlier this morning was talking about how the protests at a lot of universities is really sort of heightening the stakes on both sides, with pressure amping up on Israel, is feeling that they're increasingly isolated and what do they have to lose to go into Rafah, and then a pressure on the Biden administration to try to end this quicker because of the political liability. How do you see it reshaping certain conversations within the Democratic Party?
Oh, it's highlighting just the schisms within the party, right? I mean, if there were schisms along the immigration that we saw earlier this year between the centrist parts of the Democratic Party and the progressive wing, this is gone front and center. I mean, the images, as you alluded to, the images out of the universities across the country, particularly last night at Columbia University in New York, for example, just highlight the pressures that President Biden has. He has to coalesce young voters. He has to coalesce their suburban independent parents as well, who are concerned about probably graduations and the safety of their children on the campuses. And then at the same time, the Republicans are using it as a cudgel against him to paint Democrats as essentially the party that's more hostile toward Israel or questioning their commitment to Israel, but at the same time saying that there's an ineptitude and lawlessness there as well. So it's really boxing the president in this election season.
We saw also yesterday potentially this administration pushing for how marijuana is classified. This comes on the heels of this administration doing a lot of movement when it comes to student loans. How much more can we expect from this administration? I don't want to use the word pandering, but appealing to the younger voters of the U.S.?
Well, we're about, 6 months or so, a little close to between 6 or 7 months out from the election. And what's worrisome for President Biden is the fact that he's still trying to shore up his base, essentially. Before you shore up your base, well, usually at this point in the political cycle, you're doing the outreach, right? So you saw last week there was the ruling on, or the move on menthol cigarettes to cater toward black voters. There's student loans, as you mentioned, Anne Marie, as well. And now there's marijuana. All of these policy plays are geared towards shoring up the Democratic base.
Mario, can you just build on that a little bit? Because from the perspective of a lot of people, that sounds absolutely ridiculous. Menthol cigarettes to appeal to the black voter. Mario, is that a serious proposal of this administration?
Yes, well, the administration was under a lot of duress, particularly from civil rights groups, right? So demographically speaking, black voters, black Americans are the biggest customers for menthol cigarettes. So civil rights groups were essentially saying, why are you singling out this particular flavor of cigarettes that are geared toward, not necessarily geared toward, but that are used by or consumed by predominantly by black Americans. And so he was under a pressure along those lines to kind of dial that back. And you saw that recognition there, particularly again, as you look at some of the polls that show that he has to shore up support among that constituency. The last thing that he needed to do was fray even further.
He's certainly feeling that pressure. Mario, you're one of the best. It's good to catch up, sir, as always. Mario Parker there down in Washington, D.C. Equities right now on the S&P recovering just a little bit. We're negative by 1/3% on the S&P 500. Coming up shortly, the dollar strengthening ahead of the Fed decision. That conversation up next with Vasilios Giannakis of Aviva Investors. Live from New York on Fed Decision Day. A little bit of a promo if we can. 1:30 Eastern, special coverage. 2 p.m. decision time, 2:30 news conference with Chairman Powell.
It's going to be so exciting.
Must watch TV.
Absolutely.
Can't wait to watch.
Thank you.
of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kayleigh Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
So here's the setup. These are the scores going into the Federal Reserve a little bit later. Equity futures, negative here. They were down yesterday too. We're down 0.4% yesterday. April, closing out with the worst day, going all the way back to January. That's how bad April was, to be fair. Decent summary of things. Worst month of the year so far. On the Nasdaq 100, we're down about 0.7%. Amazon up just a little bit in the pre-market. We'll talk about that in just a moment. In the bond market, I want to go through some numbers for you. The 2-year, back through 5%, just about unchanged on the session. This came from Deutsche Bank's Alan Ruskin. I shared this with you earlier on in the show, but I'm going to repeat it for the people just joining us. The 2-year note has rallied on every single one of the last 4 FOMC days. Every single day, Federal Reserve Chair Jay Powell has done a news conference. The last 4, this 2-year note has rallied. Yields have fallen.
It's almost like the inevitability of a Fed Chair Jay Powell news conference. He'll come out, he'll say, you know, the risks are equally balanced. We think that we're in a good place, but we really want to cut. And it's sort of like, you know, Tourette's basically pushing out this idea of a dovish kind of turn of the Fed, which has happened every single time. Does that materially shift, especially given the fact that so many people want to see that disinflation expected to come, like David Rosenberg later, even if we're not seeing right now?
So the difficulty I think he's got today, and I say difficulty, I'm using that word loosely, I think the challenge for the chairman today, if he wanted to be so-called hawkish, people are going around saying he's going to be hawkish, and we've been talking about this all morning. Relative to what? I think it's easy to sound hawkish relative to the dovishness of the previous news conferences, but relative to how much we've priced in the month of April, his tone has already changed in the last couple of weeks anyway. What could he say today that would be incrementally hawkish to what is already priced, which is basically 1 cut for 2024, incrementally hawkish to what he's already said in the last few weeks?
Basically, whether he entertains hiking rates. Basically, if he entertains this and says, look, we could see it conceivably in certain situations, it's something we're open to because we really want to see the data and be data dependent in a more material way. And this is what we're watching. We're keeping it open. We think it's unlikely, but this is where we're going with this, which is somewhat what John Williams was talking about. He says that that's going to be hawkish.
Decision 2 p.m., news conference 2:30. If you're in Japan and you walk through Japan and look up at the Ministry of Finance in Tokyo or something like that, Bramo, tonight the lights will be on. And if you can see the TV set in the corner, they'll have Bloomberg and they'll have the news conference of Chairman Powell. They'll be watching this too. They will be too. The South Koreans will be, the Japanese, because they don't want him to entertain any more hikes in the face of what's happening in foreign exchange.
What do you think, 170 on the dollar yen?
It's a problem,
I mean, seriously, what do they get if you end up having a hawkish Federal Reserve chair? Is he Fed chair to the world, or is he Fed chair to the United States? A big debate whether he does sort of shift to the hawkish, how much he's really cognizant of some of the other nations that are going to really struggle.
158, just around the corner. Again, dollar yen, 157.90. This is an issue. Under surveillance this morning, tensions mounting on college campuses nationwide as protests continue against Israel's military campaign in Gaza. NYPD officers breaking up an escalating protest at Columbia University overnight. The university's president asking police to maintain a presence on campus, Anne-Marie, through at least May 17th.
Because between now and May 17th, they will have graduation. And it's not just Columbia. In the early hours of this morning, we also saw this happen in Los Angeles at UCLA, that police had to go in and break up some of these encampments. And this is going to continue. And this is what the struggle is right now for the White House. I opened up to the New York Times this morning an opinion piece talking about how difficult Biden will have when it comes to winning the Gen Z vote, which was a large portion that he won in 2020. And what's interesting is it's the same issues Starbucks is dealing with. Two factors they mentioned: the intensity of the Israeli attack on Hamas in Gaza and the frustration with an economy many see as stacked against them.
I want to see more reporting on this. I want to understand it better. Eric Adams, the mayor of New York City, coming out and saying that there's evidence of professional agitators. We've heard that before. Other people basically shrug that off and say, okay, that's a straw man argument. I am not sure what the reality is. I don't think any of us are. I really would like to see more reporting to understand what's behind some of these protests, where the motivation is collectively. Is it just divestment? Is it something else? I want to understand it better.
If you're threatened with expulsion and don't care, there's a couple of reasons for that, right? Either you're not actually at the school, you're not enrolled, you're being paid to be there, or you're super, super wealthy and you're a spoiled brat and have nothing to do with these situations anyway, and you also don't care. I can think of very few people from backgrounds that are far less wealthy, that can't afford to go to places like this, that probably get the tuition covered by the university itself, that would still be at those protests. Can you?
No, I mean, that's the reason why I'd like to know more about this, because it doesn't logically make sense. You know, knowing children who are in college, knowing people who are going to go to college, the goal is ambition and setting yourself up for a certain education. Is it something with social media? Is it something with respect to some specific goal that has not yet been articulated? I want to understand better what is behind this, because right now it's kind of a little bit like whack-a-mole in terms of some of the answers that I've been getting.
Isn't this the challenge of connecting with these kids, though? Right now, you see these interviews playing out on the news overnight, and you just sit there thinking, this is ineffective, it's not working. We're talking about how ineffective these kids are at college campuses, and we're not talking about the actual humanitarian disaster taking place in the Middle East. In fact, it's a distraction. The protest is meant to draw attention to what is happening over there, and it's actually just a big distraction.
Well, part of it, I think, is also because, and you're seeing a lot of criticism of one interview in particular with a student basically saying they're the victim in all of this, barricaded themselves within a Columbia building, and then blamed the university for not feeding them and called it humanitarian aid, which really the real issue is the humanitarian aid and the dire situation of the Palestinian people in Gaza.
As you said, there's a Shake Shack across the road if they want to leave the building.
There's a Shake Shack, there's a Hungarian bakery up there, there's a
pastry shop.
There's a good Mexican restaurant close by.
Look, I think that there's a lot of arguments that can be made. There is something bigger going on here, though, and I want to understand what it is.
I'm with you.
Think about with social media and some of the images that are being fed to kids. If they're feeling isolated and they're getting images of children dying and families being ripped apart, of course people are very angry. There is a question of the efficacy of what they're actually trying to achieve, but also exactly what is behind this.
We've got the same questions, Lisa. Elsewhere, shares of Amazon posting modest gains in the pre-market. The company's cloud unit posting its strongest sales growth in a year, but delivering a sales forecast that fell short of estimates, reflecting concerns over Amazon's e-commerce business as consumers continue to exercise caution. That name is down by a little more than 1%, or up rather in the pre-market by a little more than 1%, in between 1 and 2% through most of this morning. Elsewhere, the dollar holding steady near its year-to-date high ahead of the Fed decision at 2 p.m. Eastern Time. Vasilios Giannakis of Aviva Investors saying this: for the remainder of 2024, we do not hold a bearish view on the dollar and stress that Fed easing cycles have not been historically dollar negative. In our base case, that envisages global growth slowing, but the US achieving a soft landing. The dollar is poised for some further upside. Vasilios, I'm pleased to say, is with us now for more. Now, Vasilios, I'm going straight to upside where and against what? Because we've got dollar yen at 158, euro dollar's been stuck between 106 and 107. Where would you look to play that dollar strength?
See, Jonathan, since we wrote that piece, we have seen some rally in the dollar further. I mean, we've come down in euro dollar from 108 down to 106. In dollar yen, we have broken above 150. Now we're at 158. So I think there could be some residual strength in the dollar over the next few months. Potentially against the low yielders right now. I think preference would be against the Swiss franc, because there is that clear possibility that we're going to see an undershooting in Swiss inflation, with the S&P potentially surprising on in terms of more monetary policy easing that's currently priced. But equally, after we see that potential residual strength in the dollar, I think the next big move in the dollar could actually be on the downside, because let's not forget, over the past one and a half months, we've seen a significant, humongous repricing, especially in terms of the Fed. So that means that the risk reward has started flipping. As we currently stand. And if I was to relate that to today's meeting, based on what's priced, which is effectively one rate cut for this year, it will be difficult for Powell to out-hawk the market, given the moves that we have seen so far.
Is that a call for today, Vasilios, or just the next few months?
That's a bit difficult. I would shy away from making these very short-term calls, but I think look, the only way that I can see and sustain further increase in yields and in the dollar is if we get that one rate cut that has been priced, getting priced out in the market, and I think that can happen. At least based on what's going to happen, based on the meeting today, is if Powell completely removes that reference to the possibility of dialing back monetary policy tightening this year. I never say never, but I find this to be a bit difficult or on the low likelihood as an event.
You, like many others, are sounding like it's very difficult to really have conviction about much of anything recently. We've heard that from Jukes, we've heard that from a lot of FX strategists. Could you just give us a sense if there is anything that you have real conviction about, or if you're basically looking for a pivot point where you can kind of get a little bit more kind of confidence?
You said it. I mean, you're absolutely right. Conviction is quite low, not just in the FX market, but I think also in the rates market based on what's priced in. What, however, has definitely come to our attention is that we've started seeing some relative tentative signs of a rebound in manufacturing, in global manufacturing. We had the second consecutive month where the Chinese manufacturing PMI has been on expansionary territory. And the reality of the matter is that the Eurozone has started surprising a bit on the upside in terms of growth. So I think the dollar is a difficult call. In FX space, some relative value ideas that people could potentially explore is commodity currencies against the likes of the Swiss franc, for example, or euro against currencies where there is a lot of other high rates have priced in, or a lot of monetary policy easing has been priced out. I think a case in point would be sterling, for example, because I don't think in the UK we have felt the maximum impact of past monetary policy tightening. So I think there is a clear possibility that BOV could actually deliver more easing that the market is currently pricing.
A lot of people have been wondering with the euro dollar, for example, about how much we could potentially get a break of some of the sideways trading that we've been hearing, and about whether the Fed is going to really set the tone for the ECB and kind of tie their hands in terms of how much they can cut rates. Are you a believer in that, or do you think that that divergence with the ECB cutting more than the U.S. is going to get increasingly priced in to a currency trade pair that's been pretty flat?
So I think a lot is already priced in. I would find it a bit difficult to see more of that getting priced in. That is not to say that euro-dollar cannot fall below 105, but if I was to look at historically when euro-dollar was trading in 95 to 1, for example, that was back when we were in the midst of the Ukraine-Russia conflict. And obviously we have moved on from there. Eurozone growth is recovering, which means that is putting some sort of a floor below euro-dollar. And roughly the levels that we find ourselves in. The only risk that I actually see quite tangible is US fiscal policy, which I think seems to be on the looser side relative to where we are in the cycle, relative to where employment currently is in the US, which suggests that there is a risk of a bit more persistence in inflation and therefore getting more easing priced out of the Fed. That could be a risk that could pressure euro-dollar lower.
Vasilios, it's been too long. It's going to catch up. Vasilios Giannakis there of Aviva Investors breaking down the situation in the FX market. Haven't done this yet this morning. Bit of data coming out later. 8:15 Eastern Time, you'll get the ADP report. After that, at 10 a.m. Eastern Time, you'll get the JOLTS jobs openings. You'll also get the ISM manufacturing as well. So there's a fair amount of data going into the Federal Reserve decision a little bit later. So the first act is to get through that. We'll do that in about 30 minutes' time just to kick that off. Then the Federal Reserve decision later on this afternoon. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Dan Loeb has backed up the truck and filled up on AI stocks. His fund, Third Point, now has nearly half of its equity portfolio in AI-related names. In a letter to investors, Loeb said that it made substantial investment in Alphabet in the first quarter. It also added TSMC and the LSE in what it calls AI-driven catalysts. Even so, the tech darlings weren't enough. Third Point ultimately trailed the broader market in Q1. All right, let's get a quick check on Starbucks shares pre-market, down more than 12.5%. Not enough lavender lattes sold. Sales fell for the first time since 2020. One analyst even called it the worst set of results of any large company so far. Other companies that are retail-focused, from McDonald's to Amazon, have also flagged more price-sensitive buyers, especially from lower-income households. If this decline holds 12.5%, it will be the biggest drop for Starbucks since 2020. The U.S. Justice Department has moved to reclassify cannabis as less risky. Attorney General Merrick Garland proposed to reschedule the drug. It's currently classified with narcotics like heroin, but it would be moved alongside other medical-related treatments. Shares of cannabis companies surged yesterday with the news. Curaleaf rose more than 25%, and Green Thumb Industries jumped 22%. That's your Bloomberg Brief, John.
Danny, thank you. It stinks. You notice that, Manhattan? That's the big complaint right now. Every street corner absolutely stinks.
Yeah, we've actually had some building emails, basically. If you're the person on this floor,
totally.
it's, please have respect, just the smell.
It's amazing how that's become a thing so quickly.
Well, I mean.
I know. Up next on the program, next stop, 5%.
Are we renormalizing to pre-financial crisis levels, or are we just normalizing and then we're going to go back to the low interest rates post the financial crisis? The truth of the matter is 5% on the 10-year or 4.67 is not insane.
Earl Davis of BMO on a potential test of 5% coming up next.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Connection lost.
Stocks are lower. We're down 0.4% on the S&P 500. Yield on a 10-year, 4.6738. Under surveillance. Next stop, 5%.
Are we renormalizing to pre-financial crisis levels, or are we just normalizing and then we're going to go back to the low interest rates post the financial crisis? The truth of the matter is 5% on the 10-year or 4.67 is not insane. And if we think about more normalizing, the idea that we're going to cut all the way back to 2 or all the way to some much lower number, you have to wonder whether or not you cut back to at some point, but not to some level that's more post-financial crisis than pre-financial crisis.
Here's the latest. Yields hovering at their highest levels since November as investors look ahead to the Fed rate decision and Fed Chair Jay Powell's news conference. BMO's Earl Davis writing, quote, "The Fed wants to maintain optionality to ease in July or September, but acknowledges the diminishing window, adding tailwinds point to a test of 5% for 10-year yields." Earl joins us now for more. Oh, let's talk about those tailwinds towards 5%. Can you list them?
Yeah, we think there's a high probability and high confidence level that we hit 5%. And part of that reason is there's 3 components to a nominal interest rate, a 10-year yield. One is your break-even inflation. We see the inflation prints going higher, so break-even inflation should go higher. The other one is your real rate or your TIPS, and that incorporates a couple things. It incorporates the future view of monetary policy, of which that's changing, especially with the partial pivot that we expect today. So that's higher yields there, as well as the risk premium. And the risk premium is impacted by inflation and supply. So when you have all the components of a yield pointing towards higher yields and wider yields, it increases the confidence level and probability that you get to that level. So that's how we're looking at it. And we do see a test of 5% coming up.
Test is an important word. What about sustaining that level? How difficult might that be?
That's a great question. In the short term, it won't be difficult, but in the longer term, it would be difficult. You know, this is one of the things where we will be buying at 5% and above. And part of the reason is higher yields and the market discounting even higher yields than where the present is in the future in regards to forwards. Higher yields will accelerate us towards the end of a business cycle. You know, it's that reflexivity of interest rate markets. So we don't see us being sustainably above 5%, but we could go to 5.25%. But we do see lower rates by 1 year from this time.
This is something we hear a lot, both on the bond and stock side, that we'll be buyers into weakness, right? We'll be buyers into any kind of sell-off. Are you a buyer now, or are you waiting for that 5% level? Are you waiting to sort of see the whites of a 5% yield's eyes?
No, great question. And actually, last time I was on the show was early March, and we at that point in time we were tactically long. We switched that over that time. We are short because our confidence level in hitting 5% is increasing with the numbers that we're seeing, as well as there's other tailwinds behind getting to 5%. You know, if you have Japanese intervention, that's possible Treasury bonds selling. They're the highest holders of Treasuries, so they do have a lot of U.S. dollar on hand. But if they work through that and need more U.S. dollars, they sell Treasuries. Combine that with a lot of technical aspects in the market in regards to no one has any higher yield hedges on, to your point in your question. So people will panic as we get there. So we think it accelerates upon itself. So we are tactically short now, and we will cover that at 5% and start going long.
You talk about some of the supply and demand dynamics behind this increasing conviction around 5%. You talk about the potential sellers. I want to talk about the idea of the U.S. Treasury Department. We do get the quarterly refunding announcement in about 40 minutes' time. We'll get some sort of details about how they plan to fund a deficit that is increasing. How much is that playing into your call for a 5% yield?
It's significant. And it's not just the refunding announcement of what the next auction sizes will be, but it's the cumulative effect. You know, last week we had record 2 years, record 5 years, record 7 years, you know, and it's the whole curve of debt that's increasing. So that will definitely have impact. And what we haven't seen in Treasury yields is risk premium. And part of what you need risk premium for is increasing supply, because it has an impact on the dollar in the long term. So you want to make sure you're getting a return and your money back. And to ensure that in this environment, you need more risk premium. And we don't have risk premium in yields yet. And Treasury supply would be one of the reasons why we do start getting that.
Earl, do you see this competing for capital elsewhere? More specifically, is it competing for capital in credit? Are you seeing any sign of that?
I'm going to answer in 2 parts. The immediate answer is no. No signs at all. Like, look at the Boeing issue. $10 billion in bonds new supply bonds being issued this week, and $80 billion of bids. there is a lot of cash. So even if it does compete, there's still so much cash there. That was 8 times oversubscribed on one of the largest issues in history of bond issuance. So there's room for it to compete. But to the second part to this question, which is a really good question, it's the reason why we see higher tips and higher real yields. When your economy is so resilient and growing so fast, what the Treasury and what the Fed has to do is take the money out of the growth economy to slow it down. And the only way you do that is by having higher savings rates as reflected by your tips yield. So although we're at highs we haven't seen in probably 15 years around, or we haven't tested the high of last November, we're going to test that as well, but we'll probably make new highs in tips as well, because you have to take money out of the growth economy into the savings economy, and you only do that with higher real yields.
I'm looking right now, actually, at 10-year real yields, and we're looking at 2.3%. As you said, the highest since last November. As you look out, I mean, there's a real divide about where yields are going to end up. You said if we get to 5%, that'll expedite the sort of tumbling down to another level that's a lot lower simply because it will slow the economy. What is that lower level? How big could that rally be versus, say, not as much as people think, just because there isn't the same kind of disinflation that's down the pipeline in the same kind of way that there was pre-pandemic?
Listen, our call from December, and we said it on surveillance as well, is we see the range of 10-year yields in the U.S. at 5% to 3.25%. So I think a move to 5.25% accelerates that move back to a 3 handle. Do we see it this year? No, highly unlikely, but Q1 next year, Q2 next year, it's a very real possibility that we see 3 handle, 3.5, 3.25. So we do see us possibly testing the lower end again, but first it takes higher yields to do that, to trigger that.
Oh, you've been absolutely phenomenal this year. I say it every time I catch up with you, just absolutely brilliant. This was a clinic, once again, Earl Davis there of BMO and what's taking place in fixed income. We could test 5%, and at the moment, what aren't we seeing? We aren't seeing a profound, pronounced competition for capital with credit, given how some of these issues have gone. What he said there was so important, that you need to take money away from the growth economy towards the savings economy to slow things down, and ultimately that requires higher real yields.
Basically, the idea of T-bills and chill needs to actually catch on that much more, and then suddenly we'll have the slowdown that this Fed is looking for, because basically it'll take it away from lending to companies that can then use it to expand their businesses and potentially just continue some of the growth and heat in the economy.
Hasn't he been brilliant?
He has.
Year to date, just great.
He also really well framed the whole game theory that's going on in markets right now. We need to get there to slow things down, to then get to a 3 handle. And this is essentially where we're at, which is the reason why I'm very curious about Fed Chair Jay Powell later today when he comes up at 2 p.m. Join us at 1:30 p.m.
Thanks for the promo.
As we talk about, how he plays the game theory.
TK may or may not show up, depending on whether he wants to. I can just about see him. I think he's around.
Is this the game theory?
Yeah. Is Tom going to show for the program? I need to email him the time. We'll take it from there. Coming up, Binky Chowdhury at Deutsche Bank, Jonathan Pingle of UBS, Ira Jersey of Bloomberg Intelligence, so much more still to come. A ton of economic data this morning, and it starts next hour.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Fed is going to, I think, deliver a very, very hawkish message.
How patient will they be to get down to their policy objectives?
They do feel they're restrictive. They would rather just hang out at these levels for longer.
It's entirely possible that the Fed chair could lead us to a path where there's a little bit more tightening of financial conditions.
We need to hear what he has to say, how he characterizes the environment before the market can resume what I think will ultimately be another push higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Cricket fans the world over. AMH just compared cricket to Quidditch. Serious story. Actually just happened in the commercial break. Unbelievable.
Because your position sounded like...
Sounded like a position in Quidditch.
Like you were part of the Gryffindor team.
Okay. From New York City this morning, I apologize. Good morning for our audience worldwide. This is Bloomberg Surveillance. This hour, the economic data kicks off. We're looking for an ADP report in about 14 minutes' time. The estimate in our survey, 183K, just to get you set up for payrolls in a couple of days' time on Friday. The estimate in our survey for that, a sneak peek, 240K. Bramo, lots of economic data out this morning.
Two most important points, I would guess, this morning, which would be JOLTS job openings, not the job openings, but the quits rate. A lot of people are going to be looking at that. And then ISM manufacturing. Just how much of a reacceleration are we seeing in the manufacturing industry at times where we're seeing a bit of slowdown in some of the services sectors.
And a read on the employment component as well. I think we're going to get another read on that on Friday when we get the ISM services number. I want to go through some of the corporate earnings. You mentioned this earlier, and I think you're right to do so. How much of a slowdown are we starting to see from the US consumer? And I'll reflect on the comments that we got from a Walmart executive speaking to ABC. And we've heard this on repeat coming out of Walmart over the last few weeks or so. We're now seeing prices that are in line with where they were 12 months ago. I haven't been able to say that for a few years now. It's about the loss of pricing power.
This is from the CEO of McDonald's. The consumer certainly being very discriminating in how they spend their dollar. It may be more pronounced with lower income consumers, but it's important to recognize that all income cohorts are seeking value. So this is sort of the theme that we're hearing. You can say maybe this is sort of dismissing other pressures that these companies are feeling. Nonetheless, it's a theme that we're hearing pretty consistently.
They're seeking value, and they're going to be hunting for bargains, what we continuously hear on some of these earnings calls, and they're not in the market for $6 lavender lattes, which was very obvious for Starbucks and where they opened up this morning. I go back to continuously what Mohamed El-Arian told us months ago. Ignore some of this data because it has a lag effect. Listen to CEOs on corporate earnings calls to find out what is really going on in the real economy when it comes to inflation.
Starbucks down about 11% in the pre-market. We'll catch up with Mohamed a little bit later this afternoon, 2 p.m. Eastern time, seconds after that Fed decision drops. Equities at the moment pulling back by 0.4% on the S&P 500. Yields, we've seen quite a repricing over the last month or so. 10-year yields higher by something like 50 basis points. The 10-year at the moment, Lisa, 467.58.
And we were just hearing from Earl Davis that you could potentially get to 5%. You know, I have to say, lavender lattes is not the big thing that I'm thinking about. I'm actually thinking about, you know, the $5 cappuccino. The barrier to entry is so low. And you can go a lot of different places and get a cappuccino for $3.50. And why would you go to pay $5 or $6 for this much? And this is something you actually have potential competition.
Starbucks defends. If you don't drink regular milk, they have a lot of options across the board for non-dairy milks. And also, if you continuously purchase from Starbucks, you actually get a lot of those cappuccinos back for free.
Let the record show that on the first day of May on this program, I mentioned bonds and Lisa didn't talk about them. She talked about coffee.
Okay,
instead.
hold on. The reason why. Wait,
just
hold
happened.
on a second.
All right,
Hold on a
sure.
second.
You can have a few seconds, as many seconds as you like.
I'll just have 10, which is basically bonds are fascinating, but right now we don't know which the direction of travel is. Whether supply is going to matter more, whether demand's going to matter more, or whether it's going to be whether Fed chair says hike and then everyone goes crazy.
We're looking potentially for a Treasury refunding announcement in about 26 minutes' time. We'll try and talk to Mike McKee about that. You interested in that or no?
I am. I mean, we got
and
the actual
what
numbers.
Mike had for his coffee this morning too.
What the distribution of what kind of denominations they're going to sell it in. I think that's going to be interesting.
Testing 5% is very different to sustaining 5%. That's a conversation we'll have throughout the day right here at Bloomberg. Coming up on the program, Deutsche Bank's Binky Charter as traders brace for Fed Chair Jay Powell. Jonathan Pingle of UBS expecting a lackluster April payrolls report, and Ira Jersey of Bloomberg Intelligence as bonds close out the worst month of the year. We begin with our top story. Stocks falling on fresh inflation concerns. Deutsche Bank's Binky Charter remaining constructive, saying this: we see the pullback as just that, a pullback. The market is well positioned for volatility around the Fed decision. Unless we get a very hawkish shift, we should see the market rally. Binky, I'm pleased to say, joins us now. Binky, good morning to you.
Good morning.
3 fundamental reasons for that pullback. What are they?
Yeah, so, you know, there's basically the macro data and inflation and rates uncertainty as the first. That's here and now. We also have the geopolitical risks, and we also had basically, you know, the concerns about mega cap growth and tech earnings slowing. On the here and now, what I would say is that, you know, take a look at what's priced into the vol markets for today. It's a whopping 12 volatility points. And so, you know, what that's telling you is the market's definitely trading and positioning for a vol event. And I'd say, you know, the 2 things that you want to keep in mind is, of course, you know, as Lisa always talks about, the fundamentals and the message coming out of the FOMC is important. But I would argue, given the positioning, unless, you know, it's way outside, you know, far away from what everybody sort of expects, you're going to see those positions having basically to close afterwards. And that's very positive, basically, for the market. And so we've had a year and a half of inflation surprises up and down, and the market's rallied. And most of that just simply has to do with the positioning rather than what happens on that day. So I would say a reversal of yesterday is very likely if we get our house view of an easing bias, you know, being maintained. And the question is, how hawkish is that easing bias going to be?
Okay,
but it's
all I
still
can
an
say,
easing bias.
this is the most bullish call for a pullback I've ever heard in my entire life. We're going to get a pullback, and my goodness, it's going to be the buying opportunity of a lifetime. Because basically, well, hold a second. We had earlier today Max Kettner coming on, buy everything. Everything's awesome. It's Goldilocks-y. You come on, there's going to be a pullback, but kind of the same thing.
I actually didn't say that. I was just talking about yesterday and today.
Okay, all right. Carry on.
And perhaps tomorrow, because the positioning is going to roll. I mean, payrolls is important in what we get out of there. So the market tends to position quite a lot in the vol space. All I'm saying is, the market is aware of what's coming and has sort of pre-positioned for it. So the question is, what does it do after that? Is it a message that we get from the Fed that says we are going to go back into 2022 and we don't know, and the bias is hugely positive, and maybe up the speed and the rest of that? But barring that, I mean, it already happened, is the way that I would put it.
So this is actually really important. Are you basically saying that unless we get a real hawkish pivot that's really materially more hawkish than the market is expecting from Fed Chair Jay Powell, rates don't matter? Even if there are no cuts this year, there's only one cut this year, basically that's all been priced in, and the only surprise you could really get to stocks would be an upside surprise if rates rally.
If rates rally, yes. I mean, I think the equity market will be up, but I think even if they don't, the market will be up simply because it already happened, and those positions have to either be cashed in. Now, people can stay in, but there's 0 days to expiry options, so you can't stay in for very long because it does expire. You can roll them forward if you think, this is a fundamental and big change, basically.
This is an important conversation, Bink, and I'm pleased you brought up some of these themes because we've been talking about it all morning. We're not sitting here saying the Federal Reserve Chair will not be hawkish. It's just relative to what has been priced over the last month. Exactly. The bar to be hawkish is that much higher. There's some people getting excited by Europe. Can you talk to us about how Europe has performed in this so-called pullback over the last month and the kind of signal that you take from that?
Yeah, so, I mean, there's two issues here. One is on, the topic of the meeting today at the FOMC is U.S. inflation. And so I think, in terms of thinking about the backdrop, I mean, you should also think about European inflation. I would say there's a very wide, broad consensus that, European disinflation is on track. Growth hasn't been particularly strong, and so picture makes complete sense. I would caution with the narrative that, U.S. inflation is sticky because growth is stronger. If you measure inflation in the U.S. the way that we measure inflation in Europe, U.S. inflation is running lower. It fell earlier. We are sitting on the HICP for the U.S.
You're saying it's a measurement
2% for 9 months now. And European inflation, which is on track, is actually catching down to U.S. inflation. And U.S. inflation, measured by the CPI or the PCE is obviously running much higher. What's the main reason for that? It's owner's equivalent to rent, I would argue, is the primary and key difference. And nobody pays that. It's an imputed price. I'm not saying we should.
It's going to have consequences either way for monetary policy decisions. And I've got about 30 seconds left. And the simple question I've got for you, given that, Europe or the US, which equity market do you want exposure to?
In near term, we are overweight Europe simply because we are still coming out of basically the slowdown that we had. And I'd say negativity is pretty close to max and has been coming off. Yeah?
Binky, you're one of the best. It's great to catch up with you. It's great to see you, sir. Thank you. Binky Chowdhury there of Deutsche Bank, counting down to that Fed decision a little bit later this afternoon. Let's get you the Bloomberg brief. We can do that with Danny Berger. Hey, Danny.
Hey, John. Shares of Amazon higher by about 1.6% in the pre-market. Its cloud unit posted the strongest sales growth in a year. Now, as for the e-commerce side of the business, not too unlike some of the Starbucks conversation, Amazon's sales forecast fell short of estimates. CEO Andy Jassy said on the earnings call that customers are shopping but remain cautious, trading down on price when they can and seeking out deals. So let's get you a check on Starbucks, down 12.5% this morning. Sales at the coffee giant fell for the first time since 2020. One analyst called it the worst set of results of any large company so far. If that decline holds, it would be the company's biggest drop since 2020 of March, the early days of the pandemic. Pfizer, for its part, is higher in the pre-market. Earnings coming out about an hour ago with a sales beat, so up 1 1/3%. It raised full-year guidance, and in a surprise twist, sales of COVID pills were $2 billion, more than double what analysts had expected. That was thanks to an accounting quirk related to an agreement with the U.S. government on unused doses. But now the pressure is on to deliver growth outside of COVID. And that's your Bloomberg Brief. John.
Danny, thank you. Binky's still giving me a bit of a clinic on the equity market. That continues. Please, the mic was down. That read on Starbucks is amazing. The worst set of results of any large company so far, according to one analyst. Absolutely remarkable. Up next on the program, ADP data and a reaction from Jonathan Pingle of UBS.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
ADP report just seconds away, 15 seconds away. In our survey, the estimate 183K. And you know how this game goes. Doesn't matter, depends what the number is, then it matters for a second, and then we'll just talk about payrolls for the next 2 days. ADP, the estimate 183, the scores look like this going into it. Equity futures negative by 0.4%. Yields just about unchanged, 467. Mike McKee has the number. Good morning, Mike.
Good morning, John. It's a beat for the ADP number. 192,000 jobs is what the payroll processor says were created in the month of April. That compares to, as you mentioned, 184 last time, which has now been revised up to 208,000. Of course, private sector payroll jobs came in last month at 232,000, so significantly under for ADP, and ADP doesn't consider itself, it says, a predictor of payrolls. Goods producing jobs, 47,000, construction, 35,000, and manufacturing, 9,000. ADP had been finding job losses in some of those categories, but they do seem to be very strong. 145,000 in service providing jobs. Of those, 56,000 in the leisure and hospitality sector. So it looks like a very strong jobs report from ADP. Remember, they only measure private sector jobs, and that sets the stage for this Friday. Even if it's not a prediction, it does suggest that we're going to get a stronger report.
Mike, it's good they don't consider themselves a predictor. No one else does either, and you know that. 3-month average for payrolls, Mike McKee, 276. That is really punchy going into Friday, Mike. Can you go through some of the estimates for us?
Well, right now, what the Bloomberg survey is suggesting is we're going to see for Friday's number an unemployment rate of 3.8% and 240,000 jobs. So we'll see 190,000 in the private sector. That compares to essentially the ADP numbers telling us what the payrolls number is going to be, according to them. So another strong month. And the bottom line here is the Fed is thinking, well, we're not in a situation where we need to cut interest rates because we've got a very strong, at this point, economy going.
Mike McKee, I just want to finish with the tease ahead to what we're going to get a little bit later. We're going to get that Treasury refunding announcement potentially around 8:30 Eastern time. Can you just tell us what to look for?
Well, the Treasury had said at its last refunding that they are not going to be increasing auction sizes, so we'll take a look and see if they do that, even though the deficit is pretty bad at this point. And also, there is an expectation on Wall Street that perhaps they're going to be slashing bill sizes and start terming out some of their sales so that they can bring down the cost of longer-term bonds. But we'll have to wait and see. There's also this buyback announcement that they've been teasing for quite some time. Does that come today as well? So a lot for the fixed income desks to watch for.
Mike McKee, stay close. We'll catch up with you in about 12 minutes' time. Mike McKee there breaking down the economic data and what to look for in the next 10 minutes. If you are just joining us, the ADP report came in at 192. The estimate was 183, so that's an upside surprise. No big price action off the back of that, as you might expect. We're still lower by 0.4% on the S&P 500. On the Nasdaq, we're down by 0.6. In the bond market, yields just about unchanged. We're down about a basis point on a 10-year to 4.67. On a 2-year, down 2 basis points, but just about holding on to a 5-handle of 5.0185% on 2s. In foreign exchange, just to give you a sneak peek of what's happening with the US dollar, mixed against G10 today, against the euro, 106.74 and positive by 0.1%. With us around the table, Jonathan Pingle of UBS. Jonathan, wonderful to see you, sir. 3-month average has been really punchy on payrolls. What are you looking for on Friday? And how on earth does that ADP print inform that view?
We've kind of written a lot about ADP, and the correlation isn't great, right? So over the last 15 months, the correlation coefficient between private payrolls from the BLS and ADP is 0.1, right? So it's relatively uncorrelated release. I mean, it has some value on its own, but it's not something that's going to change our thinking for Friday, and we are expecting slowdown. I mean, the pace of payroll gains, Jonathan, as you said, incredibly brisk. I mean, punchy is a great word. The first quarter was absolutely spectacular. We actually think some of those gains were pulled forward out of what we'll see in the second quarter. So part of our slowdown is actually, we had extremely warm winter. And when I say extremely warm, like really warm, right? Like Chicago, it was 72 degrees, March 12th, the last survey. Yep. That's like, you're on Lake Michigan, like hanging out on the beach weather for Chicago. So we do think there's a substantial amount of pull forward. We see the first step of that in the April report. So we're at 200K, 165 on private. And we think you're generally going to have a string here of at least somewhat cooler job gains for the economy.
So you think it's weather-related pull forward that's led to that 3-month average of 276?
I think it's a combination of weather-related pull forward. There's also some seasonality. But let's face it. The economy's been strong. GDP growth last year was 3%. You would expect a strong labor market on the back of that too.
You have a really interesting thesis where basically you either get the disinflation that people are expecting and potentially 2 cuts from the Federal Reserve later this year, or if you get a reacceleration in inflation, you could get hikes by the Federal Reserve that take it up to maybe 6.5% next year. Where do you fall on this, given the fact that the data keeps coming in hot, including yesterday's employment cost index?
Yeah, so the employment cost index was a disappointment. But, looking at it, just taking a step back, the year-over-year percent change in private wages and salaries, which is sort of what we look at for nominal wage growth, was 4.3%. That's not really a whole lot different than average hourly earnings through March at 4.14%, right? So you are seeing some cooling. It's a little bit like the inflation data, though. It's disappointing. But we took a lot of comfort, actually, in the recent GDP report. And we've seen, a lot of the fiscal impact on growth has come through this sort of manufacturing plant construction that was really rapid in 2023. Government expenditures and investment were over 4% in 2023. Part of our thesis is that a lot of that fiscal thrust that was probably a percentage point worth of 23 growth, we think generally comes out in 24. And we see the signs of that in the construction spending data, in the GDP report. So we're still pretty comfortable with our assessment that the economy is slowing at this juncture and that the labor market's going to slow on the back of that.
Let's get to the game theory part of our program, where basically you can say this, but Fed Chair Powell can't. He might believe exactly what you just said, but if he says that, it's going to ignite a rally in markets that then only further pushes the Fed away from the ultimate goal of getting inflation down. Is that basically what you're expecting? That this is going to be a Fed chair who tries to come out and pretend he's a bit hawkish, perhaps more so than he actually feels, in order to just tamp down the enthusiasm in markets?
So I don't know if that's the game theory I'd go with. I think in some ways they've kind of gotten what they want, right? Like, you know, we've seen a little bit of the pivot, right? We had, you know, Chair Powell and Vice Chair Jefferson out the week before the quiet period, you know, clearly disappointed with the inflation data, saying, you know, it did not improve their confidence. And in fact, it looks like it's dented their confidence on how they're thinking about their inflation outlook. So I think we will hear that today. And when I look at the market pricing for, you know, last time I looked, it was a little over 1 cut this year. I think that's kind of the committee's debate right now, and we'll get a sense today of where they are. So I think Chair Powell is probably pretty comfortable. I think he will be sort of just as hawkish as he was week before last. The thing I worry about is whether or not there's sort of been a bigger shift than that. And I think we'll find that out really early in the press conference, right? So if we look back to, you know, just sort of the roadmap for the press conference, you know, if we look back to March, you know, Chair Powell starts with his prepared remarks, and it was in his prepared remarks, it's actually in the 7th paragraph in the middle, he's got the sentence where he says, you know, our policy rate is likely at its peak for this tightening cycle, and then the second half of that sentence is, you know, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. If that sentence is still there and unchanged, I think that frames the full rest of the press conference. He's not going to rule out the potential for rate hikes at some point down the road. He's not going to rule out the fact that they might not cut rates at all this year. But if it starts out with the premise that their base case, greater than 50-50 odds, is still that they're going to begin cutting rates this year, I think that is going to frame, you know, all of the other hawkish statements. And the chair probably leaves people somewhat comforted by the fact that there hasn't been a more hawkish shift. But I think he's got basically the markets roughly where they are. And I think that is kind of the committee's debate. Is it going to be 1, maybe 2 if the data starts breaking their way? Certainly if the data goes the other way, they can change their minds later. But I think, you know, for this meeting, I think that one sentence and whether it's reworked is key.
So if he socializes what the market is already pricing in, to be very hawkish, he would have to basically say there is a possibility for a hike, which is something you wrote about weeks ago that actually then started becoming a little bit more normal in financial discourse.
Yeah, no, I think, you know, he's never really ruled out the possibility. He doesn't, I mean, I think Chair Powell, at this juncture, everybody's been surprised so much in the last 2 years. I don't think Chair Powell's going to rule out anything. But yeah, the degree to which he puts that on the table obviously would be a hawkish shift. I also think that, you know, if they change that language, you know, that it will likely be appropriate to cut rates this year. I mean, if they change that language and discuss the fact that they may need to resume raising rates at some point in the next 2 years, yeah, that would be, I think, significantly more hawkish than what the market's currently pricing.
We'll talk more about this through this morning. You're going to stick with us for another 15 minutes. I want to understand if they change the first paragraph, Ramo. Never mind, what was it, the 6th paragraph of the opening statement?
Yeah, the middle of the 7th.
The middle of the
paragraph,
7th,
yeah.
Okay, forgive me. The first paragraph, this characterization of the economy. Job gains have remained strong and the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. I want to understand how they sort of reword that if they need to after the first 3 months of this year.
Has the disinflation narrative really taken a hit in a material way? And that's really, I think, what you're getting at, and what a lot of people are going to be looking for at a time where job growth is strong, yes, but what about that other side?
Jonathan Pingley, UBS, is going to be sticking with us. On the other side of this commercial break, the US Treasury refunding announcement. Mike McKee is going to break that down for you when we get that information. And then we'll catch up with Ira Jersey of Bloomberg Intelligence, looking ahead to that Fed decision later on this afternoon. Equities are lower from New York. This is Bloomberg.
of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Just moments ago, about 15 minutes ago, we had the ADP report that came out at 192. The estimate was 183. That's ahead of the payrolls report. The estimate in our survey, 240K. That's 2 days away. Looking at things elsewhere, equity futures right now, off the back of that, equity futures still negative by 0.4% on the S&P, on the Nasdaq down by 0.6. The bond market, where the fireworks might be over the next few days, particularly this afternoon, the 2 years down by a couple of basis points. The 2-year, 5.01%. We're down a single basis point on a 10-year, 466.34. The so-called Treasury refunding announcement has just dropped. Mike McKee's in Washington to break that down. Morning, Mike.
Good morning, John. Well, the auction sizes are unchanged as the Treasury promised, but we do have some other news. In terms of the auctions, $125 billion is going to be offered next week. $107.8 billion of that goes to refunding, $17.2 billion in new cash. Now, there was a thought that the Treasury would reduce bill sales, but they're not going to do that, at least not over the longer term. A slight fluctuation, they said, in the current month, and then in June, they go back to the highs of February and March. A surprise, since Treasury bills are above the 20% to total Treasury issuance level that the Treasury likes to have. They're also going to make 6-week cash management bills a benchmark bill that had been signaled for some time. And the other news is the buybacks. Treasury is going to begin the long-teased buyback program on May 29th. Weekly liquidity support buybacks will be held of up to $2 billion in coupons, and buybacks will begin under a cap of 20 separate CUSIPs, 20 separate bond issues, and that cap will eventually be lifted. So buybacks are going to begin with off-the-run treasuries starting May 29th. In terms of the refunding numbers, as I mentioned, unchanged, $58 billion in 3 years, $42 billion in 10 years, and $25 billion for the 30 years. So Treasury is keeping auction sizes unchanged, but doing some work around the edges in terms of issuance.
Just to be real clear, though, about the buyback program, this is mostly just for liquidity, right? This is liquidity management to take some of the off-the-run treasuries out of the market and put some more traded ones on the market. I am curious about what the signal is here, Mike, about the fact that it's more heavily weighted to T-bills. Is this basically an idea that eventually yields will come down? You don't want to lock in the rates where they are?
Well, that may be. They're not explaining in today's announcement why they are staying with basically the skew towards T-bills, but it does have the effect of longer-term reducing liquidity. So the Treasury may have to change going forward, especially when they get into the third quarter, when issuance is going to have to rise significantly. So at this point, it may be just kind of a holding action.
Do we have any sense, Mike, we talked about the earlier announcement on Monday about the borrowing plans and how it came in above a lot of estimates, $41 billion worth, not necessarily a massive number in the scheme of things, but do we have a sense of whether they've gotten fewer tax revenues than they were expecting? What makes up the deficit that we've seen in some of the Treasury's books?
Well, it's partly tax receipts and partly projected tax receipts, but also spending has been higher. So the government has got to make up the difference, and that's why they're going to be borrowing more. They anticipate, at least in the third quarter, of over $800 billion.
Mike McKee, stay close. We'll come back to you on that deficit in just a moment. If you are just joining us, bonds still bid, yields still lower on a session at least. We're down 3 basis points on a 10-year, 4.65 on a 2-year, down 3 basis points. Just about holding on to that 5 handle on the 2-year. Go into a little bit more economic data later, including the JOLTS report, then onto the Federal Reserve this afternoon. Jonathan Pingle of UBS is still with us. Jonathan, we've been talking about the effort the Federal Reserve needs to go to get inflation back down towards target. How much of that is being offset by what's happening in Treasury, the amount of issuance we're getting, the amount of fiscal easing we've seen?
Yeah, fiscal policy, in our view, is a huge support to 2023. I mean, we all talked about, the Biden administration programs, the CHIPS Act, the IRA, and we were all watching sort of this extraordinary boom in chip manufacturing, chip plant manufacturing, construction, all the related EV plant manufacturing, construction. I mean, structures investment in 2023 added roughly 0.5 percentage point to year-over-year Q4 over Q4 GDP. So, 3% GDP, 0.5 percentage point of that was the structures investment. Direct government spending and investment, the public sector investment, add on a little bit of the deficit widening, it's a percentage point. So a third of the growth that we saw, and we generally think of the government as being somewhat, kind of interest rate insensitive, right? So, so this was definitely a thrust that the Fed was forced to fight in 2023 with higher rates that, really wasn't going to be affected by monetary policy.
You keep saying 2023. Can we talk about 2024? How sustainable is that? How much money is still being distributed every single day into the economy off the back of these programs?
A lot less. I mean, if we think about it in terms of growth rates, it's sort of like we moved up the level, now we've got these wider deficits in this level, but the level now is kind of staying the same for a while. And that means the impact on growth is essentially going to zero in 2024 in our view. And this is sort of a natural way of thinking about fiscal policy, right? And this is why it's counter-cyclical. You widen the deficit in bad times but we've ended up sort of widening the deficit in good times. We've had the growth benefit, and now we've got sort of the wider deficit, and the growth impetus is sort of fading at this point.
As an economist, do you think that the likelihood of the U.S. Treasury Department more heavily weighting the issuance to T-bills makes sense? That basically, you can capitalize on the demand for short-term T-bills, T-bill and chill, what everyone's been talking about, and not lock in 5% yields over a longer period of time. Is that what we can infer from this announcement?
So, I mean, the Office of Debt Management, they are trying to minimize the interest expense for the taxpayer, based on their calculations. And depending upon history and how interest rates may or may not unfold, you do want some mix between bills and coupon issuance. I mean, there was a long debate pre-COVID whether or not the U.S. should term out its debt a lot. And a lot of those models actually don't say terming out the debt is really the most cost-effective thing to do for the Treasury. But a lot of it's pretty uncertain too, right? I mean, it depends on the outlook for interest rates, inflation. At this point, net interest payments are, more than defense spending. You're talking 3% of nominal GDP is just paying interest. It's almost 20% of federal government revenue. So, that could get a lot worse if rates stay high and inflation stays high, or it can get better if the Fed starts cutting.
I mean, in other words, another way to frame this question is, do you think that the Treasury is making a call that longer-term interest rates are going to go lower, and that this isn't an opportune time to lock it in?
I can't peer into Janet Yellen's mind and actually I can try, but I do think though that the Treasury is trying to balance what they're seeing on the yield curve. I mean, if that's sort of what you're getting at, and I think that's probably an appropriate thing to do for short-term funding needs, right? We certainly have seen in the money markets a reasonable appetite for bills. I mean, you can see that in all of the money that gets parked at the reverse repo facility at the Fed. I mean, the money markets are still relatively awash in cash, high levels of reserves in the banking system. So that would indicate, all else equal, that there's a lot of capacity for bill issuance there.
You talked about fiscal policy, so there's more money coming out, but there's also more people, which is propping up this economy we're witnessing. How do you see this potentially changing next year?
Well, I mean, I think the budget choices get hard, which is one complication, but the presidential election, is a hugely consequential election for fiscal policy. If we think about what's unfolding in tax policy, most of the individual side of the 2017 tax cuts expires at the end of 2025. And because that's written into current law, that is something that Congress and the next administration are going to want to address, because otherwise it's going to be roughly a almost $3 trillion tax increase over the subsequent 10 years. The plans to pay for that are likely going to look very different comparing the Democrats to the Republicans, but that could have a huge amount of impact on fiscal policy as we look out to 25 and 26.
Secretary Yellen got a grilling on this on Capitol Hill just yesterday. I'll bring a quote up from her statement. "We can make these investments while reducing the deficit by $3 trillion over a decade through a combination of smart savings and tech proposals." I want to bring in Mike McKee. Mike, down in Washington, you witnessed some of that hearing, I'm sure, watching the tape being played back. What did you think of the proposals coming out of the administration? How do they do this? Make these investments while reduce the deficit by $3 trillion over a decade?
Well, they haven't put out an exact plan yet, but the important point for the administration is they do not plan to increase taxes on anyone making $400,000 a year or less. Now, Biden didn't mention that when he tweeted that the tax bills need to sunset because the deficit is too high. So there was a big back and forth up on the Hill about whether they would do that or not. Yellen insisting they will do that. But there's going to have to be a way to make up some of the difference between the two sides. Although we are going to have to also see, as Jonathan said, the results of the election, not only who's president, but who controls each house. If the Democrats are in charge of the House and Senate, it's obviously easier to let the tax provisions expire. But if not, then we may end up with a real fight on our hands over how far they're willing to go, both sides.
She really got a grilling on this because when Biden's campaign tweeted about this, he left out the fact that he wants to keep the tax cuts for families making under $400,000. But Mike, does this just come down to the point that they're going to pay for this by raising taxes on everyone else above that threshold?
Yes, what they've outlined in the past is that taxes go up for people above that threshold, of course, on a graduated basis, and business taxes, corporate taxes will probably go up, but they won't go up to where they were before the original tax cuts. They'll go part of the way there. There was a hearing not long ago in which officials from the Biden administration were saying, look, the economy was fine. With the tax, we would be fine with tax rates that are a little bit lower, but not as high as they were. We don't have to go all the way back. They'll try to sell it that way.
Jonathan Bingle's still with us, and I am curious, Jonathan, as you listen to all of these proposals, and you listened to Janet Yellen's hearing yesterday and her speech coming later this week, how much dispersion is there about your potential outcomes for the economy based on the divergence in tax and as well as tariff policy between the two candidates?
Yeah, I mean, we've written a fair bit on this, and it's a pretty big gap. I mean, in looking at some of the plans that have been put forward, and what we can glean from the campaigns, it looks to us like essentially a Republican sweep. So if former President Trump wins the presidency and the Republicans take both houses of Congress, that they would want to fully extend all of the tax cuts. Potentially have some pay-fors, but also reduce some other taxes. And, the Biden administration, I mean, what you can glean both from, both from the president's budget proposals this year and last year, is, as Mike would say, they would, fully extend the tax cuts for those households making under 400 or potentially 450,000, let taxes rise back to the old marginal rates for those making over. But then you could also work on corporate taxes, potentially raise the investment tax, and maybe even capital gains taxes for upper income individuals. Those are very different outcomes. I mean, you really are, over a 10-year budget window, talking about, trillions of dollars in differences between, what the deficits would look like under one set of plans or potential compromise or another. And I think we get the historical template for that is the expiration of the Bush tax cuts in 2012, which was very much a similar playbook. The tax cuts expired for the upper income households, were extended for those making under a certain threshold. So we sort of have run this playbook before, and we can see what sort of a divided government outcome might look like. But certainly the Republican wave offers a much different fiscal stance, potentially.
When does the deficit matter then, economically? When is it actually a drag on the economy rather than a boost, and this sort of fuel for American exceptionalism?
You know, the deficit in some ways already matters. I mean, we saw last fall, term premium getting pushed around from the refunding announcements as we went from August, through November. And I think we could also make a case that, we're already making choices that are difficult, constrained by our, budget pressures, whether it's our defense spending, our geopolitical posture. Our fiscal stance and fiscal position now, I think, is already starting to influence policy and the choices we're making for the economy.
On this Fed Day, how seriously do you take proposals of eliminating the Fed independence?
Well, I worry. My hope is that cooler heads would prevail. I think, Congress obviously would play a very important role in the ability of any administration through appointees or through legislation to try to alter the position of the Federal Reserve System. But, as a former Fed staffer, I think that, monetary policy independence is absolutely crucial for a well-functioning economy.
But it's mandated by Congress, something that potentially the president, former president, which maybe the future president could do unilaterally, is tariffs. And he talked about this extensively in this sit-down with Time magazine. And he said potentially that ring around the country that he calls it could be more than 10%. And he says, I also don't believe that the cost will go up that much. How inflationary is, say, a 10% or bigger tariff roll around the United States?
Well, if it's on everything, you could imagine that, this is going to feed through, pretty quickly and broadly to consumer prices. It's really going to hinge on, is it everybody? Is it just imports from China? I mean, I think that's sort of the crucial question that we're all trying to grapple with, right? Whether or not they really are going to follow through with this, and whether or not, Congress could have a role in stepping in. They've delegated a fair amount of trade authority to the executive branch in the U.S. through these various provisions, national security, trade, protectionism, et cetera. But, there is also a chance that, Congress could weigh on this issue as well and try to limit the amount and breadth of the tariffs, because it would impact other treaty arrangements that we have.
He can do a ton with executive action, that's for sure. Jonathan, it's good to see you. Jonathan Pingle there of UBS, breaking down the data this morning. The ADP report about 30 minutes ago. Small upside surprise. And the Treasury refunding announcement of about 15 minutes ago. No big changes. Equity futures on the S&P negative by about 0.25%. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. CVS shares down more than 13% pre-market. The pharmacy chain cut its yearly earnings outlook for the second quarter in a row. In a statement, CVS said the trend towards higher medical costs will persist throughout the year. If these losses hold, it would be CVS's biggest one-day drop since 2022. Barclays job cuts have arrived. Now, we reported a few months ago that Barclays was preparing to cut several hundred investment bankers, and those dismissals have started today. They focus on staffers in global markets, investment banking, and research, according to people familiar. The job cuts are part of a £2 billion cost savings drive, with a CEO under pressure to improve returns and catch up to rivals. Now, the stock market might not be able to rely on Fed cuts anytime soon, but it can surely rely on corporate buybacks to boost shares. New research from Goldman Sachs says that total share repurchases will surge 13% this year, and then next year they'll cross $1 trillion. More confidence in economic growth means that companies no longer feel the need to hoard cash. You've seen it in companies like Alphabet, whose hefty cash pile allowed it to buy back shares and announce its first ever dividend. That's your Bloomberg brief. John.
Danny, thank you. Appreciate it. Up next on the program, counting down to the Fed.
When you have all the components of a yield pointing towards higher yields and wider yields, it increases the confidence level and probability that you get to that level. We do see a test of 5% coming up.
That conversation just around the corner, that decision later this afternoon. From New York, this is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Equity futures just off the lows. Equity futures down about 0.25% on the S&P. Yields a little bit lower. The rally sticks, if you can call this a rally. We're down about a basis point or two on a 10-year. 466.34. Under surveillance this morning, counting down to the Fed.
When you have all the components of a yield pointing towards higher yields and higher yields, it increases the confidence level and probability that you get to that level. So that's how we're looking at it. And we do see a test of 5% coming up. We don't see us being sustainably above 5%, but we could go to 5.25%. But we do see lower rates by 1 year from this time. But we are tactically short now, and we will cover that at 5% and start going long.
US Treasuries coming off their worst monthly performance in more than a year as traders pair bets on Fed easing. Some looking for a retest of 5% on the US 10-year this morning, 466.34. Joining us now is Ira Jersey of Bloomberg Intelligence, looking ahead to that Fed decision and Chairman Powell news conference. Ira, wonderful to see you. What are you and the team looking for later this afternoon?
Yeah, so it's going to be devil in the details, I think, in particular. So firstly, any announcement or pre-announcement about quantitative tightening going from $60 billion of treasuries maybe to 30, but that may not start until July at this point. But certainly any announcements about that would potentially be a little bit of a dovish signal. But I do think that Jay Powell has to be very balanced, and the market certainly has edged that way over the last couple of weeks with options markets, options on SOFR futures now pricing for the chance of a hike, right? So people are hedging for that potential possibility, just given the economic data we've had.
What rhetoric in the statement and in the press conference do you expect to hear that could indicate that they're actually open to that versus just simply humoring a question on it? In other words, are you expecting to hear them say that the trend of disinflation has stalled out, has not been making progress, is really a more significant problem?
Yeah, so I would be listening for, in the opening remarks to the press conference in particular, Powell's been very regularly saying we've made a lot of progress on inflation. So saying something like you suggest, Lisa, like inflation, the progress on inflation hasn't been as, robust or as significant as we'd hoped. And because of that, we will continue to do whatever is necessary to make sure that inflation comes down to our target. I think that the Fed has a little bit of a challenge here because they've kind of boxed themselves into a corner by not having a more flexible inflation target, right? When they said that they had some kind of average inflation targeting, you can fudge that based on what your look back period is. But now that they're, continue to say, hey, we want to have a hard target of 2%, the possibility that they hike continues to go up as you get, good consumer confidence numbers and some survey data that's been weak, but most of the hard data that we've seen continues to be pretty good, and that's something that I think that the Fed is trying to grapple with, this idea that some of the forward-looking survey data just isn't working at the same lags that it has in the past. People are not spending their confidence, right? Or they're spending way more than their confidence, for example. So because of that, I think that the statement has to be at least a little bit on the hawkish side. Will it be more hawkish though than what they said over the last couple of weeks? I'm not sure that it will be. In fact, I think people might be disappointed that they're not more hawkish, particularly the bears and the people who have set shorts over the last couple of weeks in the Treasury market.
It sounds like you agree with a lot of people who say that right now this is a market that's positioned to actually rally, that you could see some sort of bears being blown out of their positions if the Fed doesn't deliver the hawkishness to the degree people are expecting. Is that a correct characterization?
Yeah, I think that's fair. In the Treasury market, technical levels matter a lot because people put in stops or reverses and the like. And so 4.7% on the 10-year yield would be that key today. So if we blow through that because of something in the statement that sounds hawkish, or if Chair Powell sounds hawkish in his opening remarks, and you blow through that, we can wind up, at 475 or 490 even maybe by the end of the day. You have seen 15, 20 basis point moves on just a couple of statements here and there from out of the Fed. So that the market, I think, is kind of set up for either, a rally or a sell-off one way or the other, with, 5% that being in sight for sure. But then again, if we hold that 470 because he's not as hawkish, then you could wind up, retesting 450 in a hurry as well. So I don't think it's necessarily symmetric, but I do think that people are kind of set up and hedged for a more hawkish Federal Reserve.
Ira, we're 3 hours into this program, and up until now, I don't think anyone's mentioned taper QT once. Isn't that going to be a main event a little bit later?
Yeah, well, I did earlier. That is certainly something that we're going to be looking for. I think the challenge with tapering QT, that there's structural reasons to do it, right? And I think that there's people who say that the Fed balance sheet is way too big and stuff, but the way that the banking sector is set up today, and the need for the amount of bank reserves to meet Basel regulations, is underappreciated by a lot of market participants who are outside of the nerds in the rate market like myself. But tapering QT doesn't necessarily stop the Federal Reserve from increasing interest rates or reducing interest rates at some point in the future. And I wouldn't take it as a dovish signal. I think that one thing Jay Powell has to do when he talks about Q2 is say, look, we're doing this to ensure appropriate market function and ensure the banking sector has the reserves that it needs to function properly. And they'll talk more about their financial their financial stability mandate in doing that. And they'll try. He needs to disconnect the QT element of this more from the rate element, right? So they haven't done, I think, a great job kind of separating the two at this point.
Up until now. Ira, thank you. Ira Jersey of Bloomberg Intelligence. Good to hear from you, sir. Fantastic lineup coming up a little bit later on this afternoon on the surveillance special, The Fed Decides. Here's the lineup for you. Bob Michael, JP Morgan, Kathy Jones, Charles Schwab, Matt Lazzetti, Deutsche Bank, the brilliant Mohammed Al-Aaron of Queen's College, Cambridge, Diane Swank of KPMG, Bank of America's Michael Gapin, former New York Fed President Bill Dudley, and Jeff Rosenberg of BlackRock. It does not get any better than this. The program starts at 1:30 Eastern Time. The decision at 2 p.m. From New York, this was Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977. and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
From New York City for our viewers worldwide, a very good morning. I'm Manus Cranny. The issue for Starbucks, it's a bit of a drag. You're just not buying enough matcha lattes. That stock is getting trounced, down 13%. There's a quavering in this market. We're counting down to the FOMC. What will Powell's pivot be, if at all? Countdown to the open kicks in right now. Coming up, markets are on the edge after suffering the worst month since September. Better than expected results from Amazon, failing to move the needle. And investors look ahead to the Fed and Chairman Powell's news conference. We begin with the big issue and debate, the health of the U.S. consumer. And it is about two stocks today, Amazon on the tech side, Starbucks on the consumer side. Let's kick off with Amazon. It is about the cloud unit reporting the strongest sales growth in a year. But it did not move the dial materially. Ed, why?
Yeah, it's sort of not a hyperbolic reaction. You know, second quarter sales outlook was below consensus estimates, and the street looked past that. They looked at cloud, as you say, because following Alphabet and Microsoft, the situation for Amazon was a show-me situation. Are you actually making any money from generative AI? The answer being yes. The two data points we got are that AWS, which is the market leader in cloud, has a revenue run rate, annual run rate of $100 billion. It was a $90 billion business in 2023. And it was just one phrase from the CFO, Brian Olszewski, on the media call that I was on, which is generative AI has a revenue run rate in the multiple billions of dollars. And that seems to be enough with the stock up 3% in pre-market to convince investors that all of the investment and hype around AI is now materializing in top-line growth. And there was top-line growth in cloud. You talked about the consumer. Go back to that second quarter sales outlook being a little bit weak. Yep. The e-commerce business slowing a bit. And what the narrative is that consumers are trending down in pricing, going for the cheaper options, being selective where they spend. And I thought that was interesting.
And that is the fissure that we're trying to understand whether it grows. Ed, thank you very much. Amazon top of the block. Another one that's moving today. It is Starbucks. Sales falling for the first time since 2020. Consumers are becoming more budget conscious. The CFO said this: we were not pleased with the performance this quarter. We really sharpened our focus, and we have a clear path going forward for growth. Danny Berger is with me side by side. We debated this morning in detail. You're not spending enough on your matcha latte.
Or maybe I'm spending too much.
She's spending too
Manus.
much.
Maybe that's really the problem. I looked this up for you because I know you'd want to know. I got out my Starbucks app. I looked at how much a lavender matcha latte would set you back across the street. $6.75, Manus. And look, we can joke about this as
$6.75.
I mean, it's painful, and we can joke about this as much as we want. But what it clearly shows is the loss of pricing power. If a consumer is feeling the pinch, they can just as well go home and make their own coffee. They're not necessarily going to pay up for that pricey latte at Starbucks. So it's a consumer that we're seeing this pain across different companies too. McDonald's talked about this in their earnings call. Amazon even saying that consumers were trading down. So shares falling nearly 13%. Manus, the analyst comments were brutal. William Blair downgrading it, calling it a stunning miss across the board on all key metrics. Vital Knowledge calling it the worst set of results of any large company so far. Even had a huge miss in China too. So the CFO goes on trying to reassure investors, saying essentially that the way we're going to get people back is we're going to be more productive, get them their coffee sooner, and introduce new items for the summer, things like boba tea. So I hope you're ready to shell out $10, I'm sure, for some bubble tea, Manus.
She can bring me bubble tea one morning. I think the most brutal line that I read was from Citi. Starbucks is putting a lot of oars in the water to try to paddle. Brutal times. Danny Berger there, keeping the Starbucks dream alive. Another big story that we're tracking, it is, of course, counting down to the Fed. Mike McKee is with me from Washington to break it all down. We've had a quarterly refunding. We want to know exactly how hawkish the dovish pivot is from Powell, if you can put those two oxymorons together.
Yeah, if the dovish pivot goes away, well, we got some economic data this morning that suggests Fed does not need to cut rates. ADP employment, 192,000 for the month of April. They don't always compare very well with the non-farm payrolls number we will get on Friday, but in this case, they're very close. It was 192,000 for ADP, and last month for the non-farm payrolls, private payrolls, 190. So it looks like they're pretty close to where the consensus is for the overall economy. And that'll give the Fed pause as they meet today. There are a number of other indicators they'll be looking at. And the meeting did start, by the way, at 9 o'clock, according to the Fed. We've got S&P PMIs coming out at 9:45. We'll be back for that. Construction spending, JOLTS, and ISM manufacturing, both very important. We'll be looking at the prices paid number for ISM. Fed, put it all together, and the Fed is probably not going to move today. That's the expectation. But this is going to be a question of what do they do for the future? What do they do the next time? And there is only one clue to that today, and that's Jay Powell. There's no projections and no dot plot. There are a lot of questions, though, and this gets to what you were talking about, the dovish hawkish level. Why is inflation so sticky? How long is for longer, high? Is policy restrictive enough? And would you consider raising rates? He'll get asked that. If he answers that, Manus, we'll all go to Starbucks and Jay Powell will pay because he's being told not to talk about that, I'm sure. Also, one last thing, and that's they may announce today the official start of the taper of the balance sheet. They've already said they're going to do 30 billion, move the cap down from 60 to 30 billion. It's just a question of when that begins. So that may be a little bit of news that Treasury trading desks get today.
I think on that question, Mike, it's going to be a lot of obfuscation and creation of ambiguity around the debate on a hike. Mike McKee, he'll be back with us a little bit later on with the data. Matt Hornback is with me, Global Head of Macro Strategy at Morgan Stanley. Look, there's a hot ECI going into this, a strong ADP going into this, but we are short up to the yin-yangs going into this. So this market, what is the reaction function if he holds the line and keeps the two cuts dream alive, the insurance cuts? Matt, good morning.
Good morning, Manus. Thanks for having me on the program. Look, I think the data needs to be contextualized with some of the immigration data that the CBO put out earlier this year, as well as the strong level of productivity growth that the economy's enjoyed for the past year. I think if you think about the employment cost index in that context, it could very well be the case that this level of wage inflation is still consistent with 2% inflation in the mind of Chairman Powell. So I do think that his message ultimately is going to continue to focus on easing the nominal rate policy later this year. Bear in mind, just because they're cutting nominal interest rates doesn't necessarily mean that they're going to be easing the stance of monetary policy, because they think about that in real terms. And so as long as inflation continues to move back towards 2%, I do think, in which we think will be their baseline forecast, then we should expect the Fed to begin lowering interest rates later this year. And that's what the message will be, we think, coming out of this press conference.
Have we lost sight of some very simple facts, which are the Fed was targeting 2.6% on PCE? And this is what State Street suggested, that was for this year. And in actual fact, it is at 2.8%. The distance, that gap is small to jump the Rubicon to start the cuts.
Well, I don't think the Rubicon is particularly wide in this case. Our current projections for what the Fed will think about core PCE inflation later this year suggest that they'll move up those forecasts just a tenth. But again, that's not enough to get the Fed interested in hiking rates. And I think the other issue we need to bear in mind when it comes to the prospect for additional rate hikes is that if the Fed decides that more rate hikes are needed, you better believe it's going to be more than just 25 basis points. It's going to be probably much more than that. And so that's a very tricky situation that I think they'll want to avoid until they really believe that another 100 basis points of rate hikes are necessary.
Do you believe then, with the narrative you've just given to me, if I look at if I look at 2s over 5%, I look at 10s, I mean, they're clutching, they're desperate to get to 475, and they may even test that new band with 475 to 5. But with the narrative that you've just given to me, therefore I should be incrementally adding to duration. If you think we're at the top of the mountain, I know you say it's different this year relative to the summer of last year in terms of the spike of yields, but if you put it together, is that the correct extrapolation of what you said?
Absolutely. I mean, these are fantastic levels for investors. These levels have come about as a result of the higher inflation we've seen year to date. But investors also need to bear in mind that the statistical agencies, the BEA, the BLS, they have issues adjusting for seasonality in the inflation data set. That applies not just to consumer prices, it also applies to employment costs. And so we need to bear that in mind. So I think the Fed will be relaxed about this uptick in inflation, and the market hasn't been relaxed. And that's exactly what presents the opportunity for investors to add duration to their portfolios at these levels.
I was looking at the one year forward. This is something that Stephen, over at HSBC, we've had this video out from Stephen Major this morning. He talks about the one year forward as being the real anchor in defining where we go next in rates. When you look at the risks in this market, the one year forward is very, very stoic at the 4.6 level, 4.7 level. What is it that will change that narrative? Because energy complex is volatile and risky, but what changes the outlook?
It's definitely inflation. The labor market strength is notable and I think speaks to the immigration story that our economists have been highlighting. But I would say the real issue for monetary policy and hence for the direction of bond yields is going to be the inflation data. That's been the primary driver of higher yields year to date, and we suspect it will be the primary driver of lower yields as we make our way into the end of the year.
Okay, Matt, thank you so much for being with us. That is Matt Hornback of Morgan Stanley. Let's look at some of the stocks that are moving ahead of the bow. We've had our fun with Starbucks. Abby, take me through your view.
And we'll be taking a look at Starbucks once again. But first, let's take a look at one of the big winners on the day. And of course, you were talking about this earlier at the top of the show. Amazon shares are higher. This is all about the cloud beating because their adjusted earnings actually missed in a significant way. The guide is disappointing, but you can see the stock up 3.8% on that 17% cloud growth. They put up $25 billion into AWS revenue, better than the $24.1 billion expectation. To the downside, though, it's not just Starbucks. Take a look at CVS, absolutely plunging down 13%. They put up a 23% miss for adjusted earnings. They missed sales. They cut the outlook much more than expected, and it looks like those Medicare pressures are persisting for CVS. And then there is Starbucks, also down 13%. That stunning miss right across the board, U.S., China, and as you and Danny were talking about, they are going to try to bring in more products to stimulate people's people coming in, but will it work? That sometimes when you do too many things and you're not doing just one thing right, Manus, it could be a problem.
Indeed, indeed. Abby, thank you very much. Coming up, KKR topping Wall Street estimates in the first quarter. So we sit down with Robert Lewin, the CFO. That's next on Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
So it's a beat for KKR in the first quarter against the estimates. The asset manager changed how it relays its results. Sonali Basak has the CFO in conversation. Sonali.
Thank you so much, Manus. And Rob Lewin, KKR CFO, is joining us now here at Bloomberg. And you have your profit topping estimates. You also have assets under management topping estimates. Puts you on the way to reach the goal you've laid out at KKR to reach $1 trillion worth of assets in the next 5 years. Rob, is there anything that changes here in this higher for longer environment in terms of how you meet these goals?
Sure. Well, Sonali, thank you for having me on this morning. Maybe we'll start with the headline of the day. Our quarter is a really strong quarter for us at KKR across our core financial metrics. Even more encouraging is our forward-looking indicators. And so if you look across our three core profitability measures, that's fee-related earnings, that's total operating earnings, adjusted net income, all of which on a per-share basis were up between 20 and 28% year on year. So really strong quarter in that respect. But even more encouraging is what we're seeing going forward. We raised $31 billion of capital in the quarter. It's the second consecutive quarter where we've raised over $30 billion of capital, which is actually the first time in KKR's 48-year history where we've done that in back-to-back quarters. So really bodes well for the future.
We've written a little bit
here. And then finally, and most importantly, sorry, go ahead, Chanel.
Yeah, we've written a little here about your fundraising plans here. I know you can't talk about fundraising plans publicly, but privately we know that you're on track to raise more than $1 billion here, or roughly $1 billion for an infrastructure fund. Rob, can you give us some picture here about where investors are putting money to work? Where is most of this fundraising coming from across assets?
Sure. And so the interesting thing is if you look at KKR since the beginning of 2022, we've raised about $180 billion of capital, which is a really healthy number for us. But we've been able to do that without a lot of our large flagship strategies in the market. So as we've talked about the go forward, we've talked about fundraising being able to accelerate from here. If you look at where a lot of that capital raising has been over the course of the past number of quarters. In Q1, we had a final close of $6.4 billion in our Asia infrastructure strategy. That's the largest fund by a good margin in Asia Pacific focused on infrastructure. Lots of real good tailwinds there in terms of longer term growth. A lot of capital raising across our credit franchise. That's asset-based finance, that's direct lending, leverage credit, north of $20 billion in just this quarter alone. So there's a lot of momentum for us across capital raising, and we would expect that to accelerate. What we've articulated to our investors is we believe that we could raise $300+ billion of capital over the course of the next 3 years.
How do you feel about the money not only brought in, but the money that you're spitting back out to investors? Big open question across Wall Street in terms of how quickly firms like yours can be monetizing your assets, selling them, putting them into public markets with this kind of volatility around.
Sure. The important thing to think about when you're thinking about KKR is that we have 4 main investing verticals. That's private equity, that's infrastructure, real estate, and credit. We are also very much a global firm. And we've got, if you look at our investment professionals, north of 50% of our investment professionals today are based outside the United States. So we're always in the market, always able to pursue different investment themes that we have in front of us. Really exciting in that respect.
Do you think, Rob,
do
you think that this year that investment window can stay this open? Do you think that might be pushed out into 2025 in terms of monetization opportunities with the volatility that we're seeing?
Sure. Let's maybe start on the deployment side, and then I'll move to monetization. It's not what we're seeing. Our pipelines on deployment are building across the firm. We are really active in areas like infrastructure, all things digital infrastructure, so towers, fiber, data centers. If you look, we're really leaning in on the renewables, energy transition side of investing. We just completed our first climate investment in the U.S. in Q1, a business called Avantis, in the solar energy storage business. Really exciting opportunities for us across all areas of infrastructure. Asset-based finance is another area where we're really leaning in as a firm. I think there's a lot of really good tailwinds for the alternative asset managers in asset-based finance, and KKR is a real market leader there with north of $50 billion of assets under management today focused on that area.
In
terms of,
please go ahead. Monetization.
Yeah, sure. In terms of your question as it relates to monetization, again, we're starting to see pipelines build, and in just Q1, we exited a really successful investment for our firm, at least partially exited a business called AppLovin at north of 18 times multiple of money for our investors. So we are seeing real opportunities across the firm to be able to monetize. And likewise, just like we're seeing growing pipelines on deployment, we're seeing growing pipelines on the monetization side as well.
It sounds like you're trying to find opportunities or are finding opportunities regardless of this kind of higher for longer environment. It's Fed Day, Rob. How do you think about what the investment opportunity looks like with rates potentially staying at this level or not much lower?
So one of the unique things about our model, right, is we have over 200 companies that we're invested in across the globe. So it gives us a pretty good lens into what's going on from an economy standpoint. And we're seeing goods inflation come down. We're seeing shelter inflation come down. We are seeing core services inflation remain stickier. And we've been feeling this way for quite some time, and we've been able to position our portfolio to be able to address this. And so we do see interest rates coming down over time, but we don't see any cuts in 2024. We would expect the 10-year to probably come down to somewhere around 4% plus or minus, but all been very front of mind for us as we pursued investment themes. We've been focused on businesses now for some time that we feel can sustain margin in a higher cost environment. You're really seeing that play out in our portfolio, really healthy we've driven real investment performance on behalf of our clients again this quarter and over a longer period of time, so we're quite proud of that. And back to areas where we've been leaning in, asset-based finance, infrastructure, both have a component of inflation protection baked into those asset classes.
Speak to us more about inflation here and how inflation might be impacting your portfolio companies. And we've kind of talked about this kind of potentially higher for longer inflationary environment as well. How are you thinking about investing through that?
Sure. Back to we've got a big global diverse platform, so we're able to move capital around where we think we see the highest opportunities across the globe. As it relates to our portfolio, specifically, we feel really good with the health of the overall portfolio. There's aspects of KKR's business that are going to perform better in a higher rate environment and aspects of our business that are going to perform better in a lower rate environment. The key for us, have we set up a firm where we think that we could go out-compete our competitors, regardless of the environment. And we feel like we've got the toolkit inside KKR to really be able to do that.
But do you think at KKR you have to prepare here for potentially higher prices across those portfolio companies? And how do you prepare?
For sure, Sonali. Yeah, and we have. And absolutely, I think from a portfolio construction perspective, we feel really well prepared for that. But at KKR, we really have to prepare across different outcomes dynamically. You might be in an environment where interest rates are higher, or you might be in an environment where we're surprised on the inflation side and it could be lower. And so back to how we focus our teams, it's very much real time. The information we have back from our 200 plus companies inform our investment process, and I think allow us to stay really ahead of the curve, which ultimately benefits our clients with greater investment performance relative to the competitors that we're competing against in the market.
Rob, thank you so very much for your time here. And I know you have an earnings call ahead of you as well. That is Rob Lewin, CFO of KKR. Manis, back to you.
Charlie, thank you very much. Great conversation about how to live and invest in a higher for longer environment, KKR. Morning calls coming up. We've got FS Investments, Troy Gaetsky joining me for the opening bell to discuss the outlook for markets ahead of the Federal Reserve this evening. Context matters on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
We know it's a tough time for you out there in Starbucks. You're cutting back on your matcha lattes, but also on Estee Lauder. A big drag. The stock is down now over 4%. So again, there are various fissures here in the outlooks from these companies. Stocks are lower. We're going into Fed Day and what the FOMC has got to say in terms of Chairman Powell's narrative. Some of the calls, JP Morgan upgrades 3M to overweight after the earnings, highlighting stock attractive valuation and strengthening balance sheet. Deutsche Bank downgrades Starbucks to a hold, saying second quarter results point to pervasive and persistent headwinds. Finally, KeyBank upgrading Dollar Tree to overweight, expecting fundamentals to accelerate through the back half of the year. It's hard to believe it's the start of May. Troy Gaetsky joins me of FS Investments very shortly after the opening bell. We're going to count down to the Fed rate decision and what does Chair Powell say to the market on Bloomberg.
just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
There are fissures beginning to appear in the U.S. equity story. Have we finished with testing the downside? Powell can reaffirm the optionality for cuts still to come. If he does that, maybe that creates a floor. We're lower with Starbucks. We are lower with Estee Lauder. You're just seeing the stock market struggling ever so slightly this morning. We ran by 6 basis points on the bond market yesterday. There is the opening bell. Ahead of the FOMC and ahead of the narrative from Jay Powell. As I say, does he invoke the spirit of optionality when he speaks later on today after the FOMC comes out with their decision, which is presumed to be no change, but it is about the rhetoric from Powell. Euro is up by 1/8 of 1%. The dollar's just giving a little bit back. It had a strong day yesterday on the spike in yields. We're trading back in these yields ever so slightly. We had a moderate ADP number, and we had the Treasury auction, the schedule. It looks like they're upping the size of T-bills, and the overall size of the auction unchanged, $125 billion. More on that later on in the show. Oil is down. This is about inventories. This is about stockpiles in the United States, 4.9 million, up for the 6th week in a row, and a strong dollar, rather than anything to do with the potential for Israel joining ceasefire talks. We need more substantial news flow on that front. Look, there's one stock that is really the king of the jungle. It is Amazon. And the stock is rising, posting strong cloud sales growth on AI demand. Ed Ludlow has the narrative. So we now have a figure on the growth trajectory, the expected trajectory for AWS. And that is the strength in this story.
Yeah, that's exactly right. And actually, look at where the stocks opened on this Wednesday morning, and there's a more energetic open than perhaps the trading we got in pre-market. It was a show-me quarter where investors wanted to see tangible signs that all the narrative for AI is manifesting itself in financials. And so AWS has hit an annual revenue run rate of $100 billion. And then the commentary that we got was that generative AI specifically is also on a revenue run rate in the multiple billions of dollars. In other words, they are making money from what their strategy has been in the context of AI. The 1Q beat was significant on the bottom line. Operating income really boosted by the growth in AWS. AWS, the cloud market leader, has always been the cash cow for Amazon, in particularly consistent terms when the retail consumer-facing businesses have faced more volatility. And therein lies the rest of the story, right? The second quarter outlook from a sales context was below consensus, but on the sell side at least, there's very little discussion of the other parts of Amazon's business other than the strength in AWS, particularly from a bottom line perspective, can offset some of the margin headwinds that the retail division is facing. And I'm sure you'll talk about Starbucks and some of the other consumer stories out there, if there was one story about the consumer, it's that they're being selective at what they're buying on Amazon.com at the lower price point. Once again, advertising is a bright spot for Amazon, 24% growth in ads in the first quarter. And note that this was the first quarter where Amazon put ads on Prime Video. There seems to be some evidence that was successful. The stock actually paired its early gain, up 2.4%.
Got to say, the adverts are a little bit interrupting and jarring. I think I might upgrade to the ad-free zone. But that's the whole point about it, isn't it? What level of interruption will you have in your viewing? We could never be interrupted viewing Bloomberg Technology with yourself and Caroline. That's Ed Ludlow on the Amazon story. So the world's second largest maker of computer processors, giving a lukewarm forecast. It's AMD. The stock is slumping after delivering weaker than expected forecasts. Abigail Doolittle has the narrative, down 7.5%. That's a brutal response, Abby.
Indeed, the stock is heading to its worst day in about a month, having to do with that tepid forecast that you talked about, plus a lukewarm quarter that they just reported, numbers basically in line. So the gangbusters growth that they had for some time not happening. A big piece of this are gaming chips, or weaker demand there than expected. They put up overall $5.7 billion worth of revenue, or excuse me, the expectation for this quarter is $5.7 billion worth of revenue versus the street of $5.72 billion. Not a huge shortfall, but given the fact that this stock has been up 75% over the last year, I think that that's really weighing on the minds of investors, that they want strong demand everywhere. Speaking of, AI is expected to boost projections in the future, perhaps though just not in this current quarter that we're in, that's a little bit short of the street. And this, of course, also follows Intel last week giving a tepid forecast. So it seems like some of these big chip companies struggling, Manus.
Okay, Abby, thank you very much. Great roundup. Abigail Doolittle there. Let's turn our attention to Tesla, the EV maker, axing almost the entire supercharger team, cutting nearly 500 jobs. Now, this is continuing to be a tumultuous year for the company. Craig Trudell joins me. I mean, this sort of defies logic for me, Craig. The whole paradigm shift is to make it easy for me to plug in, believe I can go anywhere, and here we go. Supercharger looks as if it's something in the rearview mirror for Tesla and the industry.
Yeah, I think that last bit is really key because, you know, it'd be one thing if this was just a story that is detrimental to Tesla. I think we would maybe be able to chalk this up as, you know, Elon Musk being Elon Musk and you know, making moves that, you know, are going to help or hurt Tesla. In this case, it's really a move that has the potential to be very disruptive to the broader industry, just given that we're only a few months into car makers like Ford embracing Tesla's superchargers and, you know, even redesigning their vehicles going out years so that Tesla's plugs work with their ports. And so some real questions here about, you know, just how disruptive this is going to be to the future of this network that has been hugely valuable to Tesla and to the broader EV ecosystem.
Craig, thank you very much. The stock slither lower after yesterday's little bit of a shakedown. Okay, Craig Trudell there on the Tesla story. What have we got? We've got some signs of a slowing consumer. Starbucks sales falling for the first time since 2020. A budget-conscious consumers tightening up their belts. Let's get to Isabel Lee on the health of the consumer. These are idiosyncratic moves. You've got McDonald's, you've got Starbucks. Pull it together for me.
It may just really tell a broader picture, Madison. This is in the face of half-off deals in Starbucks and a lot of new products like lavender oat milk latte. And investors really are feeling jittery because shares are down around 14%. This is the most since 2020. We're seeing the biggest drop there since the early onset of the pandemic. So the company reported a 4% decline in same-store sales, which is a key metric for growth. And this is despite analysts' forecasts of a gain. We also saw overall number of transactions falling around 6%. And during the call, we have the company cutting its full-year revenue growth forecast and saying that adjusted EPS may be flat. And even the analyst comments weren't that good. We have Vital Knowledge saying that this might be the worst set of results from any company so far this quarter. And we have William Blair downgrading the stock, saying that the stunning across-the-board miss on all key metrics is just noteworthy. So Starbucks has really struggled to keep up with lofty expectations as it enters a new leadership. We have the CEO who has just been in the job a little more than a year, and since then he has already lowered guidance several times. The CFO actually put it more bluntly. He said that they weren't happy with the results this quarter, but that they have a path moving forward. So we'll see where that path really goes. But for now, it just really underscores the challenge of $6 lattes as we see rising inflation. Shares are still lower, and year to date, Starbucks shares are also down 20%, Manus.
Well, the consumer votes with their feet because there's always a coffee shop within short distance of your neighborhood Starbucks. As a cruise ship, it takes a toll. Troy Gajewski is with FS Investments, and he says this: remember, the U.S. economy is like an aircraft carrier or a ginormous cruise ship. It takes a tremendous amount to force it to turn meaningfully away from the steady state growth up or down. Guy is with me now. So look, this, Troy, here we are. The steady state of the U.S. is strong, resilient, with sticky inflation. So my question to you is, with that consequence in mind, no rate cuts potentially this year, do you still remain fully and firmly overweight U.S. relative to the rest of the world?
Well, it depends. I mean, the issue for the U.S. is not growth, right? When you look at broader markets, and obviously we have the global champions in technology. You went through a lot of the earnings, obviously very strong earnings. For the most part, a few disappointments. The issue has really been multiples. So that's what we've been grappling with. A lot of others have been grappling with. What's the appropriate multiple given the free cash flow generation power of a very narrow market? And when you think of the path, we were at 21.2 times coming into the pandemic, dropped to 15.75, reflated back up to 21. And given the fact that obviously bond yields have gapped higher, and there's really very little hope for the Fed to bail anyone out anytime soon, we're through another round of multiple compression. So I think the question for investors is, where do you get growth? It's obviously in the U.S., but then how do you execute it? And most investors already have healthy exposure to market cap weighted indices. So one of the areas that we're really focused on now is middle market private equity, where you're getting growth at a reasonable price. And as long as we can avoid a recession, you can compound EBITDA at 15 to 25%. You're going to have very good outcomes for investors over the years.
What proportion? I mean, if you look at the classic destruction of everybody's life is 60-40, battered and bruised by 60-40. And you make this point, 60-40 was a correction in the summer of last year. Here we are again. We're waking up. We've got 2s over 5%. We've got 10s careering towards 475. So therefore, are you actively reallocating away from 60-40? And what portion of that then should be private equity?
Yeah, so it really depends on the client, right? No client's the same. Obviously, there are a lot of investors that.
Well, let's just take a moderate risk. Let's just take a moderate risk, high net worth individual with money to deploy who wants a return more than 5.25% in a CD.
Yeah, so look, the greater wealth management channels, the Morgan Stanleys, the UBSs of the world, are recommending somewhere between 20 to 30% in alternatives. And within those models, usually it's 5 to 15% in private equity, depending upon, again, their risk tolerance, their age, their liquidity position. And so that's really the direction we're going in. Right now, the penetration rates are only 4 to 5%. So there's a very long window for investors to not necessarily catch up with the Yales or the larger institutions, but make it a much more meaningful part of their portfolio. And when you think of the use cases, really, from 2017 up and still today, the primary use case has been to replace or complement fixed income. What we're seeing much more now is the urgency to deploy cash, but do it in a way where you're not taking uncomfortable levels of risk, can walk into a duration-related drawdown or another period of multiple compression. So, the outlook looks very bright, but again, no strategy is perfect. You are sacrificing liquidity. There are lockups that are associated with these strategies.
Look, we're counting down to Chairman Powell later on this evening. You identify the risk is either an endogenous shock or an external shock. You make it very, very clear that it's one or the other. It's endogenous or exogenous. I just wondered to what extent could we have an endogenous shock tonight? In other words, the removal of some kind of language from Powell about the risk of rate cuts, no rate cuts this year. In other words, moving away from at some point this year. Is that just too high a left tail risk?
Yeah, so when you think of the most likely endogenous shock coming within the system right now, it's the continued drainage of the balance sheet. There was a lot of expectation that the Fed would start or announce a taper at this meeting and start slowing the pace of that balance sheet drainage. Given how hot the inflation data is, that could be pretty challenging to do right now. So as that liquidity is drained, the reverse repo facilities drop from well over $2 trillion to right around $500 billion. And you look at the issuance, the massive levels of issuance that we're having in the Treasury market, it's very easy to imagine some type of shock that hits treasury yields where you gap up to 5.5% or maybe even 6% briefly. So that's the most obvious endogenous shock that we see. Hopefully the Fed gets it right. They've already drained or taken a third of the balance sheet expansion that they did in the pandemic off. Money supply has been stagnating really since Q1, Q2 of 2022. So that's the most obvious endogenous shock for markets. Fortunately, that will more than likely have a more negative impact on markets than the real economy, because as you quoted me before, it takes very powerful forces to move the economy away from that 1.5% real growth rate, which is what we're settling into now. It's just nominal growth is still too high for the Fed's comfort zone.
But this is the battle, isn't it, between QT and the Treasury at issuance and the function of QT. I mean, just run it past me again as to what could spike me up to 5.5%. What is the risk? Is it about the issuance comes out of sequence to what we think it's going to be, just materially higher?
Yeah. So you put yourself back in September, August of last year. Yeah. One of the key drivers of why yields gapped higher is issuance levels were coming in far, far, far higher than people expected. And you had almost a borderline panic in the Treasury market where yields gapped higher. And then mainly for technical reasons, because almost every macro manager was massively short the back end of the curve, you started to have a short covering rally that was justified by, issuance is a couple billion lower than we expected, so this is great. And it's like, no, it's not. It's not great. It's technicals driving yields back lower. So we had another kind of bullish move in the Treasury market. But where we sit now, obviously the inflation data is not beneficial at all. The probability of the Fed not cutting at all this year has gone up dramatically. And if we keep having these over-expected issuance levels, it's definitely a possibility to see yields make new highs in this cycle, which most investors just aren't prepared for, unless, of course, they've embraced alternatives in a democratized way.
Yeah, you see, plug in the alternatives. Tell me this. I mean, no, you're okay. The consumer, I mean, UBS, the hedonism of the consumer, beautiful phrase from Paul over there. But here we are. The consumer is choking at Starbucks, reluctant at McDonald's, and searching for deals on Amazon. It's changing, isn't it? There is something changing in the consumer, and I can't quite put my finger on it.
Yeah, so this is one of the areas where the macro ties up to the micro from an earnings standpoint. So, when you think about one of the key reasons why we didn't have a recession in 22, when every single factor that contributes to GDP went negative, it's because consumption was still so gosh darn strong because of the excess savings and the white hot labor market we had. Yep. So what's really happened is, excess savings have been completely run down, particularly for, the lower 5 deciles of the income population. The labor market has deteriorated from, let's call it white hot, to somewhere between warm and red hot. And so you have seen the crack show up in the lower income consumer, whether you look at auto defaults or credit card default rates. So we've been following that for quite some time, and now you're starting to see it show up in earnings, as you point to McDonald's and Starbucks in particular. So, the consumer is in good shape, but there are cracks. The consumer's clearly not as strong as the position they were in 2022 or 2023. So when you think about from a risk management standpoint, what that really means is if there is some type of meaningful endogenous or exogenous shock.
I think it's going to come down to whether those cracks spread out in breadth and depth in the consumer. Troy, thank you very much for being with me. Troy Gajewski, there of FS Investments Market Strategy on Bloomberg. Context matters.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Well, MasterCard are out with their results. The shares are down after it cut the forecast for revenue for the year. Joining me now is Jess Menton with the details. Now, the cut in itself, we need to talk about the scale of that cut and the data behind that. Just disaggregate it for me.
That's right. So looking at this stock for MasterCard, ticker symbol MA on this, that stock's down about 2%. So this would be on pace for its worst day since February 20th. But when you look overall, what really you're seeing within the numbers, you're still seeing strong consumer spending there. It was when you're looking at network spending, that was what specifically missed estimates. So they ended up putting out some guidance here. They're looking at growth in net revenue is expected to be at the low end of low double digits for all of 2024, compared with prior guidance for growth at the high end of low double digits. If you want to look at some of its peers, though, in the S&P 500, in the payments processing sub-industry group in the S&P 500, that's down about 1%. So obviously it has peers like Visa and PayPal in that as well. But of course, you do have MasterCard and then also Capital One, because they're going to have that acquisition of Discover Financial that would create the biggest credit card issuer here. And of course, one of those cards that they issue is MasterCard. So the company has said that they will comply with those changes that are going to happen here. But if you look at its peers, though, Visa also beat on earning estimates. And then you have American Express. It did see revenue jump about 11% in the last quarter. If you look over at the A&R function for MasterCard, you have about 41 buys, you have 4 holds, and 0 sells right now. And so really looking at total network spending volume around $2.3 billion for the first quarter. That was up about 8.6% from a year earlier. But unfortunately, that didn't miss estimates, Manus, for about $2.1 trillion.
Okay, Jess, and as you said, one of the biggest issues is Capital One paying up $35 billion for Discover Financial. It's going to change the landscape. More on that, I'm sure, as the deal flows in. Jess Menton. Well, S&P Global U.S. Manufacturing PMI, the numbers have hit the tape. Mike McKee is with me to break them down. He's had a lot of work to do. He's had ADP, he's had auctions. What have you got for me on this data?
We've got an awful lot of economic data coming today, Manus, ahead of the Fed meeting. And the latest is the S&P Global Manufacturing PMI, which rises above the contraction level, hits 50 exactly. Last month, it was at 49.9. Now, this sort of sets the table for the ISM report coming up at the top of the hour. ISM also expected to come in at 50, although that would be a slight decline from 50.3. Be much more interested to see the prices paid number and perhaps the employment employment number for ISM. We'll watch for those and have those for you at the top of the hour.
So what's the betting now on the dropping of the language of rate cuts, guidance on easing at some point this year? It would be quite visceral if that was removed from Chairman Powell's narrative this evening, Mike, wouldn't it?
Yes, I think they're going to try to avoid that and say that they still think, essentially, as that statement puts it, that they could cut rates this year, but they're not really going to want to go out on too much of a limb because they're starting to become very unsure about it. What'll be interesting is what Jay Powell has to say about it, whether he admits the possibility of raising rates at all. Some people thinking that might be in the cards this year.
Okay, that certainly would be something that could punch those yields up to 5% on the 10s and take us to new highs through the 2s. Mike, thank you very much. Mike McKee will track all of that. And of course, we've got a Fed special for you a little bit later on today. Abigail Doolittle is with me with some of the sector price action. Abby.
And we're looking at a second down day in a row. Most sectors for the S&P 500 are lower, suggesting that there's a broad-based decline here. The worst sector, staples, down about 1%. Mondelez, the big drag there. But tech is also down sharply, down 0.6%. On the other hand, consumer discretionary being helped out by Amazon, up about 0.75%. The oil and services sector, though, this week so far, Manus, down about 4%. This as oil has fallen nearly 10% over the last couple of weeks.
Okay, Abby, thank you very much. Coming up, your market moving events. We're going to set your clock by a trading diary. And guess what? Part of that will be a Fed special right here on Bloomberg.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. You're listening to Bloomberg Intelligence. Alex Steele, Paul Sweeney, we are live here in our Bloomberg Interactive Broker Studio. Some economic data coming out, ISM manufacturing data a little bit weaker than expected. We're going to break that down with Tim Fury. He's the chair for the Institute of Supply Management. We'll talk to him in just a moment. Plus, Dennis Lockhart, former Atlanta Fed president. He's going to join us as well to break down what we might hear from this Federal Reserve this afternoon at 2 p.m. Wall Street time. Also in this hour, Jeffrey Cleveland, chief economist at Payden & Regal. He's going to join us to give us his economic call. So again, economic data. We got the Fed today at 2 p.m. and we've got lots of earnings to break down. Alex Steele and me, we're with you for the next 2 hours, and we will do that for you. Right now, let's kick it all off with Lisa Mateo in the Bloomberg Business Flash. Lisa.
You got it. Market Drivers brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interest at ibkr.com/RIA. All right, Wall Street traders. Well, it looks like they're holding back from making those big bets ahead of the Fed's decision on interest rates. Comes out at 2 p.m. Wall Street time. Our coverage begins at 1:30 p.m. Wall Street time. Before that, we received a lineup of economic economic data, so bear with me here. An ADP report shows private payrolls increased 192,000 last month. That's after an upward revision to the prior month. The March JOLTS print, that's also been released too. Let's get to it right now at 8.49 million. The survey was for 8.68 million. Then we have S&P Global Manufacturing PMI for April, up a tick at 50. The survey and prior were for 49.9. Then we have construction spending. This is month over month, down 0.2%. The survey was for going up 0.3%. And finally, ISM manufacturing for April in at 49.2. So a bit of a disappointment, contracting a bit from the survey at 50. Paul and Alex are going to break that down in much more detail with the lineup of guests we have. Over to the stock market. So like we said, things are a little changed. NASDAQ down a tick, down 0.1%. S&P 500 down 0.2%. The Dow is little changed. Over to the yields, the 2-year yield at 5%. That's down 3 basis points. And the 10-year yield at 4.64%. And that's down 4 basis points. That is your Bloomberg Business Flash. Paul and Alex.
All right. Happy Fed Day. Happy Wednesday. Happy Hump Day. I'm Alex Steele alongside Paul Sweeney. That ISM manufacturing number, that prices paid. That's something. It jumped quite a bit in March also.
Yeah, exactly. So I'm looking in, so that data, we're going to break it down in just moments, but I'm looking at also the JOLTS data, a little bit lower, 8.5 million. The consensus was like 8.68 million. So the JOLTS openings, but a little bit fewer job openings out there.
Yeah. So, okay, if we all paint the brush, we have a slowing-ish economy with inflation still-ish high. Tim Fiore is the man behind the ISM. He is chair for the Institute for Supply Management. He breaks down all the data for us. We love giving you this instant analysis of the data as it crosses the terminal. Tim, always great to see you. Walk us through these numbers.
Yeah, good morning, everyone. Yeah, a little bit of a disappointment, but not, don't overreact to it. There's so much emotion around the 50 point, 51 versus 49.9. So we came in at 49.2. We sagged a little bit. The 4 elements that I watched for demand, 3 of those weakened a little bit. But I think this is just a bump in the road. I believe we're still on the track of expansion that we started in January. On the output side, the revenue was good. We're still destaffing, but not as much as we were in the prior months, which I think is the appropriate thing to do. And the big disappointment this month was really the input side, where the suppliers are still delivering faster, which is a bit of a surprise at this point. And the manufacturing inventory account is still contracting, again, a surprise. And as you mentioned, Alex, the prices number coming in at almost 61 is definitely an eye-opener. So did a bit of research on that, and it seems to be all commodity related. It's steel, it's aluminum, it's plastics, and to some extent, crude oil driven, petrochemical driven, but not as much as the basic foundational commodities. So, I think we hit a little bit of a bump here, but I still believe that we're on the growth trajectory.
So, Tim, do I interpret that prices paid, again, it came in at 60.9 versus a consensus of 55.4, and a number last period, 55.8. So the higher prices paid, so I take that as inflationary, right?
Well, it means that in the month, people paid more people paid higher prices than they did in the prior month. Okay. So you could say that they're faced with higher prices for sure.
And you mentioned it was commodities, so understood that, okay, commodity pressures can be transitory, but nonetheless, walk us through the inventory, production, and new orders. So inventories are unchanged. Production fell and new orders fell. So is that just that companies have restocked enough and they can hang tight for now, or is it an end demand issue?
No, they fell, but they're still expanding. So they slowed their rate of growth.
Okay.
On the production side. We had a bit of a surprise, I think, last month on the production number being so strong from something that was slightly contracting, I think, the prior month or at flat. So we're still expanding, but at a bit of a slower rate. So that's positive. On the employment side, we're still contracting, but at a slower rate. So we're not letting as many people go, which I think is appropriate too at this point. At the end of April, if the second half of the year is going to be stronger than the first, then at some point you got to stop letting people go. And I think we talked about that last month, and I think that's happening now. So nothing unusual on the output side, I think. I would love to see a much more robust production number, but it just wasn't to be in April. Remember, April's a pretty strong manufacturing month. It's really the beginning of some pretty heavy output. So there's some seasonal factors in here, but I'm not going to say that that's the issue. I think we had a bit of a bump. I'm still optimistic about May. The pricing number is obviously concerning. We've had a couple of months here of growth. It's foundational, which on one hand you could argue, okay, that's because demand is coming back and prices are stabilizing and in some cases growing. If that's the case, all right, fine. But you still have to deal with the inflation number.
Great stuff, Tim. Really appreciate it. Thanks for the instant analysis. We know you have a busy day for you. Tim Fiore of the ISM manufacturing team. He's the chair of that. ISM manufacturing coming in a little bit light. Prices paid jumping to over 60. Although Tim trying to even it out, saying, you know what, it's a bump, relax, make it still be good, let's not overreact.
Yeah, we'll play it by ear. So, again, looking for the trend there, but a little bit of a concern there. We'll take a look. Markets here, red and green on the screen here. Alex, indexes, not a lot of movement, not a lot of direction here. Let's check in with Nora Melinda. She covers the equity markets for Bloomberg News. She joins us here in our Bloomberg Interactive Broker studio. Nora, what are you looking at?
Lots to look at this morning, but I wanted to take a look at Starbucks. So
yeah, double tall mocha.
Yup, that's your order?
And double tall mocha. Yeah.
What's
or double
yours?
short mocha, actually. I got to go to short.
Double tall. I'm like, is it giant?
No, now the double tall, the tall is the smallest size, go figure. But I'd never finish it. So I wish they had a smaller one than even the small. And they actually now have double short mocha, which is perfect for me.
It's like a mini.
Yeah, double short mocha. Boom, there you go.
The more you know.
Yep, there you go.
Anywho.
So what happened?
The company is seeing its worst day since March of 2020. It's plunging as much as 16%. Now, this is coming after its sales fell for the first time in 4 years. And so it does seem that its new lavender lattes and its half-off deals aren't doing enough to entice consumers who are still clinging to their wallets, of course, in this tumultuous economic time. But the shares are hitting their lowest level in 2 years, and the company did cut its full-year revenue growth forecast to low single digits and said that its adjusted EPS may also be flat.
Yeah, I gotta say, a lot of the earnings that have rolled in over the last 12 hours have really made me say, okay, there's a portion of this economy that is really struggling.
Yep.
And we're seeing it reflected kind of all across the board. And I was really surprised in the likes of, say, now you're gonna talk about tech in a second, but like Yum Brands, for example, the areas where you think people go when they are struggling are the ones that are struggling, which I found to be quite interesting. You're looking at tech. So AMD, which you would think would do really well because of AI, that's a video game issue, right?
Exactly. I mean, that's where they are seeing the largest pullback. The chip maker provided a lukewarm revenue forecast for the current quarter. It's really seeing that pullback in demand for, as you mentioned, video game hardware chips. And so, of course, this is kind of coming after Intel earnings, and we have been seeing a bit of a mix in regards to the tech space. But its second quarter revenue will be about $5.7 billion, the company predicted. That's against estimates of $5.72 billion. And it's really just interesting. We have shares sliding as much as 8.1% in trading this morning.
All right, anything else for us?
Yeah, I mean, I want to look at Amazon. Let's give a positive story here in the downward framing, but Amazon shares are climbing as much as 4%. Now, this is because of its cloud unit, which apparently is its most profitable unit in the business. It posted the strongest sales growth in a year. Now, the company's sales forecast for the current quarter did still fall short of expectations, but investors are really focused specifically on the cloud unit and the robust bounce back that we're seeing here.
All right, Nora Melinda, thank you so much for joining us. Nora Melinda, she covers all the equity markets for Bloomberg News, joining us here in our New York City studio. It is Fed Day. Again, coverage will start on Bloomberg Radio and Television starting at 1:30. Bloomberg Surveillance Special. You got Tom, you got John Ferry, you got Lisa Abramowitz. They'll be bringing you all the analysis starting 1:30 p.m. Wall Street time. Dennis Lockhart joins us here, former Atlanta Fed president, joining us from Atlanta. Dennis, I have to ask you before we even start, if you tell me your office is located on Peachtree Street, I'm going to jump out the window. Is it on a Peachtree Street?
Indeed it is.
See? See?
My current office, which is my home, is on Peachtree Street, and it's about 5 or 6 miles north of the Fed office, which is also at 10th and Peachtree.
See, I mean, before there was Google Maps, or I got lost in Atlanta every single time because every single street is Peachtree Road, Peachtree Street, Peachtree Avenue, north, east, southwest. I don't know.
Every handle you can put on the word Peachtree is used
and we're saying peach, right? Like
peach.
The fruit?
Yes, peach tree.
Huh.
You know, it's a phenomenon just specific to Atlanta. I don't know. I know they've got a secret code down there. Dennis, what are we going to hear from our Federal Reserve today at 2 p.m. Wall Street time?
Well, I think, first of all, I don't think the statement is going to break new ground, so I think it's really a question of Powell's press conference. I think he needs to kind of thread the needle here, come off as a bit balanced, I don't think he wants to encourage any expectation of a near-term cut, meaning at the June and July meetings. But I don't think he also wants to abandon the idea that that this year we will see some rate cuts. And to add to that, he probably cannot take off the table the scenario in which there's a rate hike. So to me, he's got to come across as balanced and measured and in a certain sense non-committal.
Which I'm sure he's going to try very hard at all the 17,000 questions that ask about a hike to do that. How, in your experience, and you're taking a look at the economy and the data that's coming in, which is showing some softness, how quickly can an economy cool? How soft can an economy get, knowing the data points we have right now?
Short of a shock of some kind, a supply shock is what we've experienced recently, I think the cooling will be gradual, and it will, it will be in a way fighting something that seems to be fueling the current resilience in the economy, and that is that we have a very good employment economy. When people are employed, they tend to have confidence in their income stream, and consequently, they tend to consume. And that's what's, as simplistically at least, that's what's driving the current strength of the economy. So we're going to have to see some consumption slowdown, which so far we really haven't seen a lot of.
Dennis, there are some folks out there that are making the argument that the Fed pivot, if you will, in December to a more cautious, more dovish tone, that actually contributed to some of the inflation we're seeing here in the first quarter of 2024. Do you buy that?
Well, inflation expectations have risen a little bit. That's always a red flag for the committee. They get concerned when they see expectations rising, and we've seen that happen. That, on balance, should be a cautionary note, that means they're going to maintain their posture of, I would say, slight hawkishness in these circumstances.
To build on that point, I mean, you look at financial conditions index, like it's not tight. So when the Fed says things like, we think that we're at restrictive enough policy, why do they think that?
A very good question. It may very well be a question that they're reconsidering. Oh, wow. I think, we've seen the economy tolerate this level of interest rates with apparently very little problem. The economy continues to move along very robustly, even with the current setting of policy. So it wouldn't surprise me at all if individuals, at least in their Fed speak after the meeting, say that they're not so sure that the setting of policy is as restrictive as they thought. Now, one thing to keep in mind is the 10-year has moved from about 430-ish to 465 to 70, and that's tightening. That's not tightening policy, but that's tightening financial conditions, and we've seen that in the last few weeks.
Yeah, to be fair, I mean, this is why I take notes, Paul.
I know.
Because this was an Ira Jersey thing from yesterday, and I was like, that's a brilliant question. I'm stealing it, and I'm writing it down. So there you go,
good.
Paul.
It worked.
That's why I do it.
Dennis, is there a scenario here for 2024 where there are no rate cuts?
I don't think you can dismiss that idea. I don't think it's a base case at the moment, and I don't think the committee, importantly, has abandoned the outlook or the view that they will ultimately cut rates later in the year. But I don't. I think it's a non-zero probability that there are no rate cuts this year.
So we'll have to. I mean, I guess 2 o'clock we'll hear from the Fed here. I guess also, Dennis, just real quick, a rate hike, is that something that you think will be discussed or was discussed yesterday and
Definitely
today?
going to be asked.
Yep.
I think at this time, Chair Powell and the committee overall probably don't want to entertain a rate hike as they don't want to create the market aftermath that would occur if there was a serious discussion of that. But at the same time, Powell can't take it off the table because he's got to keep, I think, the committee's options open to deal with whatever develops in the coming months.
All right, Dennis, really great perspective. Thank you so much, Dennis Lockhart, former Atlanta Fed president, joining us from Peachtree Street, we decided?
Yeah, so in the bio page, I mean, it's Peachtree, and it's Peachtree Street, Peachtree Road, Peachtree Avenue, and it's not just that, northwest, southeast, northeast, and so literally,
totally get lost.
And you'd be sitting there and you give the cab driver an address, and if you didn't have it exactly perfect, he'd take you to a completely different part of town.
Oh,
Like 40 minutes away. I mean, it was crazy. I'm like, he'd be taking me somewhere. It's like, this isn't Invesco.
You're like, this is somewhere very different.
Yes.
The things we learn here on Bloomberg Intelligence. Okay, coming up, we are going to talk to Jeffrey Cleveland. He's chief economist at Payden & Regal. He'll be joining us to discuss the Fed meeting, his outlook for the economy. And my question is, if you don't get any cuts, is that in essence a hike? Can we start talking about that? We're going to break that down in just a moment. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Traders kind of doing a little tiptoe before Fed Day and also after weaker than expected factory and job openings data. Right now, the Nasdaq down about 0.2%, the S&P 500 down 0.3%, the Dow up 0.1%. Over to the 2-year yield at 5%. That's down 2 basis points. The 10-year yield at 4.65%, and that's down 2 basis points. Take it over to commodities. Spot gold higher at 2,306 an ounce. We have Brent crude at $85 a barrel. NYMEX crude at $81 a barrel. Quick look at currency. As the dollar was weaker, the Japanese yen, euro stronger, the British pound weaker. Bitcoin down 4% at 57,321. Earnings also in the focus. One hit a couple. We'll get to Amazon. They're up nearly 3%, posted strong cloud sales growth, and that was thanks to AI demand. We'll stick with tech. We'll switch over to server maker Super Microcomputer. They're down 15%. Investors had these high expectations, but quarterly sales, they fell short of estimates. And finally, Advanced Micro Devices down 6%, had a slowing demand for chips used in video game hardware. That is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, Lisa Mateo. I'm Alex Steele alongside Paul Sweeney. We're live from Interactive Broker Studio right here in Midtown Manhattan. This is the Bloomberg Intelligence Radio Show, where we cover all the top economic and financial news for you with a lens through a Bloomberg Intelligence analyst. They have an amazing coverage scope, 2,000 companies, 130 industries all around the world. We also tap our super solid lineup of external guests as well, who really knee deep in all the data that we're getting. The latest is that ISM manufacturing data, disappointing. The JOLTS number also coming in a little bit lighter, but yet still relatively strong. Jeffrey Cleveland is chief economist over at Payden Regal. He joins us now from Los Angeles. Jeffrey, it is Fed Day. It is a big day. A success for Jay Powell would probably be a nothing burger. What kind of burger do you want?
Well, okay, I was hoping for some more excitement, actually. Happy Fed Day to you, Alex. I mean, we're not going to get any move on rates. I don't see a lot of incentive for the Fed chair to try to move markets. Markets have moved towards, a more hawkish stance, removing a lot of the policy accommodation that we saw priced in at the start of the year. So I don't know if he needs to do much, but I was hoping maybe just to stir up something, we could get an announcement on the balance sheet. So put aside rates, and they have been doing this quantitative tightening for most of the last 2 years. And they said, or at least Chair Powell said, he wanted to fairly soon begin the process of slowing the pace